morning, everybody. It is a TGI Friday. This is Squawk Box Asia. I'm Martin Soong.
TGIF for sure, everyone. I'm Chery Kang alongside Martin Soong in Singapore. Let's get to your headlines this hour. Gains across the board for the major U.S. averages. The Dow, S&P, and NASDAQ all closing at record highs. Investor sentiment boosted by news of OpenAI hitting a $500 billion valuation, fueling momentum for the AI trade.
Also, the market is in what me worry mode for now, but that depends on just how long the shutdown lasts. Treasury Secretary Scott Bessent admitting it could hurt the economy, and he's blaming politics.
There could be a discussion, but this isn't the way to have a discussion. Shutting down the government and lowering the GDP.
On a more positive note, Bessent also said we can look forward to what he called a pull-aside meeting between President Trump and China's Xi Jinping in South Korea later this month, and that there could be a big breakthrough.
So good morning. I should probably say welcome back to both of us because we were just back from a couple of days down at Milken, right?
Exactly.
The Asia Summit.
Did you hear me choking at the top of the show at the hello? It's like TGIF. No, because I'm like this week was massive, and I'm just I find it fortunate that I cannot really soak in all the information, all the great insights that we're getting from events like Milken this week, and perhaps we'll spend the weekend to sort of go back to some of the conversations. But we're going to continue some of those conversations right here at the SGX as well. So let's first recap, Marty, on the action on Wall Street just overnight. All three major averages closed at record highs overnight as investors shrugged off concerns about a U.S. shutdown. Taking a look at, the board really says it all. So green across the board, not a huge upside for last night alone, but we are talking about record high levels, and that is actually sort of inviting a lot of questions around bubble. We'll see. Quick check on treasuries before we move on here, and the treasuries mostly pushed down, so the 10-year at just over that 4% mark there. So a lot of softening in the rates in recent sessions. Hopes for a shorter shutdown fading, though, as U.S. lawmakers are not planning to vote on funding bill again until Monday at the earliest, and we're not expecting any jobs numbers on Friday until the shutdown is over. So no data point coming out later tonight, Asia time. An extended lack of data is expected to add uncertainty to the Fed's monetary policy outlook. Now, there's also a looming question about how big the federal layoffs during the shutdown will be. So that is going to be really the major conversation, obviously, going forward. Meantime, CNBC spoke to U.S. Treasury Secretary Scott Bessent overnight, who weighed in on what this would mean for the U.S. economy.
There could be a discussion, but this isn't the way to have a discussion. Shutting down the government and lowering the GDP. We have a 3.8% GDP. And when the Democrats shut down the government, that we could see a hit to the GDP, a hit to growth, and a hit to working Americans.
And we've had a busy week for sure, Marty, as we said at the top. And in and out of the studio at the Milken Asia Summit and here in, of course, in Singapore, and plenty of great discussions that we had around the markets. And, let's actually hear a little bit of my panel. It was on global private markets and some doom and gloom that I actually detected. And here's a sound from Yup Kim. He is the CIO of Texas Municipal Retirement System. Take a listen.
I think 2020 will be a terrible vintage year. I think people overpaid. I think people were overly aggressive. I feel pockets of private markets, second half of 2025 feel that way too, right? And so I think obviously AI is going to change all our lives, but the prices being paid for some assets today are probably too high.
So that was his response to my question around, look, rates are coming down. there is a little bit of optimism, some kind of exuberance, if you want to call it that, because that could actually lead to IPO market coming back, and that actually open up a little bit of a window there when it comes to exits.
Yeah.
But it's the valuation. If you got in 2021, 2022, then even if you are looking at IPO, the valuation, it's not really matching the level that you're looking at. I mean, the returns are not exactly there. So I think that's what he was referring to.
So let me throw a wrench in the works there, right? For PE guys hoping for that, for lowering rates to mean faster and better exits, right? Part of that is going to depend, the IPOs that is, right, on how long this government shutdown lasts, right? Because if it lasts longer, it's going to make IPOs hard. It's going to make the SEC's job hard.
Yeah, I know. So I know that a lot of market guests we've talked to, they're saying, okay, as long as it's not too prolonged, things are okay.
Yeah.
But do we know how long this is going to go on, and how long is really prolonged, right? To for the markets to figure out, okay, this is not okay, this is not okay. So, by the way, we've got Yup Kim actually standing by right outside the studio,
right.
so we're going to continue the conversation. We'll definitely pose some of the conversations around that. In the meantime, there's another trend that I was picking up in terms of private markets here, and that is fee compression. Fees are coming down, and that is actually sort of leading to this changing relationship between GPs and LPs. Actually, take a listen to another sound. She's actually Wenting Gyuk. She is the head of private equity at Mercer, talking about that changing relationship between GPs and LPs.
So fundraising is actually very difficult right now. So we are seeing that managers are very open to terms negotiation now, as opposed to days where they were very good and a lot more engaging. So it's great. We see our GPs communicate more during times like this. And again, back to my initial comment, we also get more co-investments as a result of enticing investors to come into.
So co-investing, sorry to interrupt, but it's basically, I got the money, I want to go in there, but I want to go in there with you so that I can bring down the fees.
Yeah, that's right. So usually managers will offer no fee, no carry. Depends on the manager, but no fee, no carry co-investments where you can put additional money into the portfolio companies that the fund is investing into. So you're kind of double downing on some of the investments there.
So we're in the, no carry kind of world when it comes to private investing. And LPs are saying, look, I will go in with you, but I want to sort of share the burden, and we can bring down the fees, and I got the money, so we can co-invest. So that is the new trend that is playing out in the private markets. So tough times for GPs out there.
Not easy. And you've got another panel coming up in just a couple hours, right?
Yeah. So earlier this week, we had this fascinating conversation with PIMCO's Christian Strack, and I think he really got the message out there, and he's been saying that there are some concerns, cracks around direct lending. And that's not what he's pushing for. At PIMCO, they're saying we go for collateralized asset-backed because that's safer. But when it comes to direct lending, he did sound a bit cautious. We're going to pick up on that comment. We're going to talk about private credit markets later on this morning at Milken. So I'm going to be gone halfway through the show. Is it private credit? Is it too concentrated right now? Is it too popular? Can accidents happen? So fascinating conversation that is coming up.
Great lineup as well, because your panel has guys from Blackstone, from Goldman, and also, as you suggested, from PIMCO. So we'll have a lot of highlights to look forward to on Monday from you. In fact, if we're lucky, we may actually dip into some of your panel a little later this morning.
Yeah.
All right. Meantime, coming up on Squawk Asia this Friday, lots to talk about with David Roach. Is Europe on the brink of war? Are tariffs and reshoring manufacturing at odds with each other? And a lot more when we come back after this. Welcome back. CGI Friday here on Squawk Box Asia. Let's get a look at the Treasury market, showing how yields are pricing the 10, the benchmark at 0846, the short end 2s at 53.88. CNBC's Rick Santelli has the full bond market report. Take a look.
Good morning, Asia, Australia, New Zealand. 2-year notes had about a 3.5 basis point range high to low. 10-year notes about a 4.5 basis point range low to high. Those are really small ranges. Volatility, whether you looked at price movement in the actual cash market or you looked at the options market from an option volatility standpoint, in either case, volatility was low. Plenty of volume, just not a lot of movement, as investors do understand, and they really weren't as aggressive as they normally might be because there's such a void of economic information to trade off of. Today, we didn't get initial or continuing claims. Trade deficit. Tomorrow, we're not going to get the big September jobs report. However, we are going to get reports that don't go through the government. For example, we'll have the S&P Global and ISM PMIs in the service sector tomorrow at 9:45 and 10 o'clock Eastern. So there will be some new inputs. And, of course, we all know yesterday that we had ADP jobs because it's not a government-related entity or a compiler or distributor by the government. And that data proved to be very weak in terms of its description of the labor market due to negative job creation. And that was exaggerated a bit in the marketplace. It was one of the big reasons yields have remained, for the most part, at the low end of yesterday's range from a news/economic standpoint. The equity markets once again managed to close in historic record territory, so they certainly don't seem to be negatively affected by the closure. But ultimately, the government being closed in some of these key reports that will help us understand how the glide path of the labor market is stacking up to what the Fed believes the glide path is or will continue to be, that's really an important issue. The longer the shutdown, the more damage that it could do to the marketplace, but it's still a little early to tell exactly what that may be or how long the shutdown would last to be the catalyst for some of those negatives. Reporting from the CME HQ, I'm Rick Santelli, CNBC Business News, Chicago.
So I think the key point is there is a glide path for the Fed and rates, and that is downwards. Let's bring in David Roach, strategist at Quantum Strategy, joining us live. David, great to see you. Always a pleasure having you on the show. So this idea that rates are coming down, obviously public markets, equities, they're liking that. And Chery and I were both down at the Milk in Asia Summit for the last couple of days, and she was telling us about how a lot of the people in private markets have been telling her they are excited as well because it potentially means sooner, quicker, better exits for them. IPOs, in other words, right? But the wrench in the works potentially could be this darn U.S. government shutdown. We're in day 3, and people are going, look, is it going to be like Trump won, 34 days? What do you think?
It's a little bit like the U.S. weather, really. U.S. people get more excited about it than the rest of us, and very few of the U.S. people actually go outside to see what the bad weather is like. So I'm not too excited about it. Look, it could become bad if it went on for a month. It's the most unlikely to. Whichever side is picking up the political opprobrium will cave. It's the usual pattern. But and the people who don't get paid during the shutdown, the people, the federal workers who go to work but don't get paid, they get paid afterwards. They spend more money afterwards, but there's a little hole before they do. And frankly, I would say that it has no effect on the Fed policy. It'll look through it. And so I'm afraid I'm in the camp which says it really doesn't matter that much. Where it would matter is if the president uses this to do what Doge could not do and fires a whole lot of people who don't get back their jobs, and that creates more social disharmony, and it affects consumer spending more permanently because people lose their jobs on a permanent basis. But I don't really expect that.
All right, pretty sanguine, but we watch the labor market, of course, for impact. And here's the thing. I mean, last time around, 2018, 34 days, that was about immigration. This time around, and we're in day 3 again, just to recap, right? It's about healthcare, and 24,000 healthcare workers stand to lose their jobs because of what just happened 3 days ago. And this potentially could just be the tip of the iceberg, because you would think that, this would be a pretty good opportunity for Trump to press on with what he wants to do in terms of jobs and depopulating the federal government.
Well, the more he depopulates the federal government on a permanent basis by doing what you described, using this as a kind of Doge surrogate and getting rid of a whole lot of people on a permanent basis, then the more it'll harm consumer spending down the road. But the likelihood is that this will be quite a small effect. And that the bigger effect will be that the people who are working now are not getting paid, or the people who are not getting paid will then go back to work, get paid again, and then they will consume more. And this kind of hole which the shutdown creates in consumer spending may actually be made up by a kind of hill on the other side of that hole. We simply have to see. But I'm not overly concerned about it. I think there are bigger things to worry about.
Yeah, bigger things to worry about. I mean, if we see more job losses, it means more unhappy, if not angry people. And what brought Trump back to power a second time was this rising tide of populism. You have thoughts about that?
Well, I think populism is very important because it's a way of governing which really has never taken over power in the way that Trump has taken over in the United States. And we're seeing things which are really quite interesting in an objective sense. We're seeing a kind of alternative economic framework being put in place where instead of taxes, it's tariffs who pay the taxes. Instead of monetary control, you have stablecoin, which also feeds into the demand for treasuries. And you actually get into this weird world where all the spending which the populists want to do for populist things actually gets covered for a year or two by the inflows from protectionism, i.e. tariffs, and from the inflows of kind of financial innovation, if you want to call it that, which is actually using stablecoins to fund the budget deficit and create demand for U.S. treasuries. It's a weird world, but you want to be very careful about saying it's going to end tomorrow because it could last for a while. It's not sustainable. It's a very kind of fragile form of economic equilibrium, not backed by economic fundamentals. But then, of course, economists have a horrible habit of being completely wrong for longer than anybody expected.
It's a weird world for sure. I mean, stable coins potentially coming to save the day for the Treasury market in the U.S. November 5th, you're worried about that. Supreme Court's ruling on Trump's tariffs. I mean, I think the Trump administration might be operating on the premise that they may not get the full Congress support for these tariffs, for these executive orders. So maybe it's really about the financial re-engineering of the U.S. economy, trying to bring down the deficit side and so on. November 5th, is that going to be still a problem for the tariffs as well as for the markets?
It is probably going to be a problem for the markets, whatever way it goes. And let me explain one thing in the beginning. Sure. I think that the revenue from the tariffs will cover the big, beautiful budget deficit, but it will not cover the budget deficit, which was there anyway. That's 1.7 trillion US dollars. So that isn't going away. What it does do is cover the 200 to 300 billion extra money which Trump is spending or causing not to be collected in taxes. So that's what it does. Now, why the tariffs are so important is because they cover that amount of spending. And there can be three outcomes to the Supreme Court ruling. Number one is they simply say that the tariffs imposed under the IEEPA, the emergency powers, are illegal. End of story. Trump's Trump's architecture of populist economics falls out of bed immediately. And you have a huge hole in the Treasury funding market, which will lead to, big rises in interest rates and a loss of confidence in the dollar. The other solution is that they say, okay, well, everything is legal. And then you're going to get Trump going absolutely haywire and imposing tariffs on countries where he doesn't like the color of the dogs. Or he's going to impose tariffs where he doesn't like the Chief Justice. And I can go on and on and on and on. But for instance, tariffs on U.S. companies which are not repatriating production fast enough would be very high on his list. So on that side, you get really an almost berserk imposition of tariffs by a newly confirmed and confident president. And then you might get something in the middle, which says tariffs aren't really legal, but you've got 1 year to take them off because we're really we the Supreme Court are going to take into account the good of the whole American people.
Yeah. David, let me jump in here. I mean, obviously, we've been thinking a lot about this issue and the possible outcomes of three of them, which you just outlined. But let's take it up to 30,000 feet. How much do we know about how much legal precedent there is for an issue or a case like this one? And I don't mean to cast aspersions on, the independence of the U.S. judiciary, much less the Supreme Court, but it's pretty obvious it is leaning right, or has been for a while.
Yes, but the leaning, of course it is, and it's packed. The majority of the judges have been appointed by Trump and therefore take decisions which are kind of in line with his thinking. But let's look at another aspect of it. Most of the conservative, so let's say the more Trump-leaning judges on the Supreme Court, do so because they are fundamentalist. They believe that the original drafting of the U.S. Constitution should be adhered to. And in that drafting is the limitations of the power of the executive. So in a sense, the traditional Trump liberal split in the Supreme Court may not apply to a case which involves defining the power of the executive in a way which affects economics. So that is the reason why it is not impossible that the Supreme Court will rule against him.
Interesting. How important is it for Trump and Xi to meet in South Korea for APEC? I mean, Treasury Secretary Scott Bessent sort of teasing it as a potential big breakthrough if they do meet there. What happens if one of them doesn't show up, or there isn't really, I don't know, anything significant or meaningful that comes out of that meeting?
Well, to be perfectly frank, and with the greatest amount of respect for Scott Bessent, he's been predicting great breakthroughs since the first meeting in Geneva. And if I was holding my breath for those great breakthroughs to materialize, I would probably face would have turned purple and I'd have died before I ever got on this show today. I think the most likely thing to say is there will be a meeting. Certain things will be conceded, but China it has come to the conclusion, I think, that they don't want to concede very much to America for two reasons. Number one is they think Trump is unstable, and that therefore what they agree with him will not be adhered to. And number two, they believe that America is on the way out, and that Trump is a symbol of the weakness, the structural weakness of America. So they're not going to give away a lot.
David, can I jump in here with number three? Because of China's control over rare earths, as we've seen in the coming to five rounds of talks between the two sides, that is their key point of leverage, and they can get the U.S. to do almost anything because of that, including 3 months after banning H20 chips from NVIDIA. Boom, they're back in China. No?
Look, it's magnets at the moment. The big thing now is not the rare earths themselves, but the things you make out of the magnets. And if you look at the trade in magnets from China, despite all the agreements to be nice about strategic minerals, rare earth magnet shipments to America are down in volume terms by about 15% at the moment at the run rate. And magnet shipments to Europe are up about 20%. So that tells exactly the story that you were telling. The other one you have to add, Martin, is the fact that if you look at trade, China is doing pretty well on trade. Its exports are consistently up to the rest of the world. They're down to America. But the real hit is being taken by America in the drop in container shipments to America, which are, the consumer goods for Christmas. So America is actually paying the cost of the protectionism against China, and China's trade picture is doing pretty well.
David, if you look at trade and tariffs especially, right, as, two sides of this whole idea of trying to reindustrialize America, obviously the other side would be reshoring manufacturing, right? You think those two ideas or those two policies, the way they're enacted, they're actually at odds. They work against each other. You can't have your cake and eat it.
Well, as you rightly point out, they're illogical, but then that's nothing new in the policies of Trumpism. If you reduce the imports and cure America's trade account and deficit, current account deficit, then essentially those imports are not flowing into the country. If they're not flowing into the country, then you don't get the tariff income, and therefore your budget deficit becomes a problem again. So no, those two things are a non sequitur, and you cannot square that circle. But I would say one thing, the effects are quite slow. If you look at the tariffs coming on goods coming into America, they should be at about between 16 and 17% on an effective tariff rate, but they're actually only running at about 10. So people have got all sorts of workarounds where they get the goods into the United States, but they don't pay the tariffs. That means that because 80% of the tariffs that are imposed are absorbed by U.S. corporations, then the consumer actually switches away from imported goods more slowly.
Yeah, yeah. David, it's great to have you on. Thank you so much. That was David Roach from Quantum Strategy. Squawk is going for a quick break here. Plenty more conversations on the sidelines of Milk in Asia Summit coming up. Welcome back to Squawk Box Asia. On this Friday morning, U.S. President Donald Trump and Chinese President Xi Jinping will have a pull-aside meeting when they meet in South Korea later this month. That's according to U.S. Treasury Secretary Scott Bessent. Secretary Bessent telling our U.S. colleagues overnight that he expects a pretty big breakthrough when he meets with his Chinese counterpart as well. Yesterday, Trump posted on Truth Social that soybeans will be a major topic of his discussions with Xi, following reports that China stopped buying U.S. soybeans over the past several months, turning instead to other producers like Brazil. Bessent weighed in on how U.S. farmers are getting caught in the middle of the trade dispute, but he said he stays optimistic about the outcome of a Trump-Xi meeting. Here is a part of what he has to say.
Well, there's plenty the president can do, and it's unfortunate that Chinese leadership has decided to use the American farmers, soybean farmers in particular, as a hostage or pawn in the trade negotiations. And American farmers overwhelmingly voted for President Trump. More than 90%. He loves the farmers. He loves them. We have great Secretary of Agriculture, Brooke Rollins. Three of us were in the Oval yesterday, and you should expect some news on Tuesday on substantial support for our farmers, especially the soybean farmers.
All right, so in case you haven't noticed, Chery and I have been spending a lot of time the last couple of days down at the Milken Asia Summit talking to folks, and JP Ong as well. You caught up with Indonesia's Deputy Trade Minister.
That's right. Her name is Dia Roro Esti Widya Putri. And also a timely matter actually with the interview, Martin, because it came a day after Indonesia's trade data actually surprised to the upside with exports coming in better than expected. And that's surprising because that's the August trade figures where we expected the tariffs, of which Indonesia faces about 19% on top of their goods exported to the United States, would have actually gotten hit. But there is a sign of resiliency. Key to this also is Indonesia's own efforts to try and build more free trade agreements with other partners like the European Union, African countries, and even those in the Gulf region to try and offset any potential blowback from trade to the United States, given that the U.S. is also one of their three biggest export markets in the world, just after ASEAN and China. I also asked her about what the feeling was and the mood was among exporters in Indonesia 60 days since the tariffs actually came online, and whether or not they're still feeling concerned or shocked, or whether or not there's a sense of resilience right now or a sense of confidence that they can move on. Here's what Dia Roro Esti Widya Putri actually told us with regards to the mood from exporters in Indonesia on the sidelines of the Milken Summit just the other day.
We just signed a deal with Canada, the Indonesia-Canada Comprehensive Economic Partnership Agreement. We also signed a CEPA one with Peru, so Indonesia-Peru CEPA. Substantially concluded the Indonesia-EU CEPA, right? These are the markets in which we believe would be great for our commodities. But outside of that, we're also exploring more non-conventional markets, such as those in Africa, perhaps, in Mozambique, in Tunisia. We're also expanding to the Gulf countries, to Sri Lanka, right? So there's a lot of opportunity. And this is quite exciting for us to kind of learn more about, and vice versa, because when we're talking about trade deals, we're talking about how Indonesian products can penetrate to the international market, but also vice versa.
Yeah, and I want to get deeper into that because it's interesting to find out where Indonesia is diversifying. But going back to the exporters in Indonesia, are they still concerned? Are they a bit worried? Or because it's been 2 months and they've had time to actually digest the tariffs, do you think that they're actually a little less panicked now, if I may use that word, as compared to, say, 60 days ago?
Yeah, so in the case of the U.S. tariffs, right? So if we're talking about the U.S. tariffs, we see that there has been a lot of improvement in terms of those figures. So initially, we were set at around 32%, and now it's gone down to 19%. And of course, our negotiating team are working very hard to ensure that there is good engagement, good conversation, and are coming to terms with a mutually beneficial kind of solution for both countries, that of Indonesia as well as the U.S. in this sense. So that sends a good signal, of course, to our exporters, meaning that goods being sent abroad are going to be cheaper, right? It's going to be more friendlier for their business and in terms of the economy as well. So that sends a positive signal, a relief, if you may say. And apart from that, I think in that way, exporters are also open to many other potential markets. Through the trade agreements that we've recently just launched, this may be an avenue for them to explore, that there are other markets out there which may demand the types of products that are currently being sold or sent to the U.S. So, for example, high industrial products, we're talking footwear, we're talking apparel, we're talking rubber, for example. So these are one of our strengths when we speak about the Indonesian exports, and understanding that there are other markets out there who are demanding these products and these goods as well. So there is a positive signal being sent to the business players, the private sectors.
So really, right now, it's a full court press, really, for Indonesia and other countries in Southeast Asia to try and widen the number of trade partners they have to try and at least mitigate the impact of these tariffs. But they are hopeful that things will continue to stabilize and that exports, the momentum that they've sustained in August, will continue. However, we are expecting that perhaps the tariffs imposed by the United States will really make itself felt in the coming months. So again, the big question really is, okay, the August numbers were better than expected, but can they actually sustain that? And a lot of this will actually depend on how many new trade partners they can invite, how many more people they can actually speak to. So that's top of mind for many of these trade ministers out in Indonesia and really across Southeast Asia as well, Chery.
And I was actually talking to Bakri, Kadin chairman, and the question is, did Indonesia give away a lot to the U.S. to sort of walk away with a number, a lower tariff number, and call that a win? Can they do that? Would it actually offset some of those concerns for the Indonesian economy? I think that is really the major question.
Right.
Yeah. JP, thank you so much for bringing us that conversation. And let's get back to the conversations on the ground at Milken and the overall investment appetite, both public and private. Earlier, we played some sound from the global private market panel at Milken earlier this week. But let's bring in one of the participants, a headliner in that conversation. Yep Kim is the CIO of a Texas Municipal Retirement System, joining us live right here at the SGX. Yep, good morning. How are you doing?
Good morning. Doing well.
Yeah. So do you think, looking at Wall Street price action, it's not just the U.S. equities that are at record highs. Do you think, okay, this is the time that we hold new capital, this is the time that we pull back here because things are a little too optimistic and exuberant?
Sure. I think markets are certainly kind of well priced, but I don't know that it's to the point of exuberance, right? I do think some of the key things that investors and markets are focused on today is, number one, is inflation moderating, giving Fed the confidence to cut rates a couple more times. Number two, is the global earnings growth momentum that's really driven by AI, robotics, semiconductors, is this strong enough? Will it continue to offset some of this softness and weakness in some of the other sectors? And lastly, it's really around government, right? Just are there continued regulatory easing, pro-growth fiscal measures, and lastly, some tariff relief. And so I think investors are really focused on these three key areas, and if these three key areas continue to surprise to the upside, then I think there is still another leg of a rally left in the market. And just two last points there is, I think investors are also watching closely kind of a rebound in emerging markets in China, as a lot of the global demand is sourced from those regions. And lastly, investors are really looking for a bit more of a balanced, kind of rally, right? Today, just in the past couple of years, it's really been driven by kind of tech mega, stocks. And so I think this is kind of the state of the markets today.
Yeah, but rate cuts are coming. AI is there to perhaps support productivity. We're off the, hopefully, tariff-related uncertainty, then things are okay when it comes to public markets. But what you said at the panel on private markets earlier this week, you said in the second half of this year, you see pockets of some overpaying in private markets. So how does that work together?
Sure, absolutely. I think whenever you have an exciting megatrend in front of you, like AI, I think when you take a look back at the turn of the 1900s, right, when the Ford Motor Company was founded, there was probably several hundred, if not 1,000, different car companies that came to being. And today, only 3 or 4 of those companies made it. I don't know if it's 5 or 3, but a very few amount of them made it. And so I think we're kind of in a similar period, right, with a lot of these, AI companies being formed. Obviously, there's different layers to kind of this, episode of AI kind of revolution that's coming. But I think, especially on the app layer, it's very difficult to be precise around who's going to win and not. And some of the valuations being paid there, I think the market will acknowledge that is very, very high.
We were joking earlier this morning, right? Because she was telling me about how she was talking to you on your panel and how yourself and some other folks involved in the private markets were getting excited or optimistic about the fact that rates are starting to come down. Because it's been a tough couple of years for private markets, right? But with rates coming down, maybe the prospect of quicker and better exits, IPOs. In this case, though, we've got the U.S. government shut down yet again. Depending how long it drags on, right? It's going to make the SEC's job a lot harder. It could delay IPOs as well. Does it concern you?
Yeah, look, I think when you look at history, the past 50 years, I think there's been about 20 government shutdowns. 17 of them just lasted a few days, right? 1 to 3 days. And only 3 of them lasted, anywhere. I think the longest one was about 35 days, right? And so,
Trump won his first term.
Right. And so I do think a lot of, investors are watching kind of kind of the duration of the potential shutdown and its severity. And just looking back at historical market data, the stock markets usually weren't impacted, right, by it. And I think there's just a broad acknowledgement from investors as well. It's it's difficult to underwrite, some of these things, and so I think it's a bit more of a wait and see and reactive approach as opposed to trying to underwrite exactly its impacts immediately.
So talking about duration, TMRS,
yes,
220,000 members, 943 cities, 40 billion trust fund assets. About 5 billion of that is in private, right? Which is about, I think, back of the cocktail napkin math, about 12.5%. When I take a step back and look at pension funds, I think this kind of looks like an insurance company in a sense, right? Because you've got a lot of long-term liabilities, and you probably hire a lot of people with degrees in actuarial science, right? Private investments, you're at 12.5%. Are you comfortable with that, or does that need to go? Do you want that to go up?
Yes. So we are. So just broadly on our. So just to answer it directly, that number is coming up, right? And so across private markets, we're actually closer to 40-45% today. So that encompasses private equity, private credit, and real assets. In private equity, we're about 12%, and our target is increasing to 20%, right? And so I think when you look at our strategy from a very high level, on the public market side, we're largely taking a low-cost passive approach, right, to market returns. I think it's very difficult to beat market sometimes, right, on that end. And even if you are incredibly good at selecting managers that outperform, you only get the difference between a median investor and a top 5% investor is about 3%, right? That same number in privates can be 15 to 18%. Right. So you're you're better compensated for being good selectors of fund managers and of deals in private markets. And so that's really where we're trying to find a lot of our outperformance and also engaging in direct co-investment activity. So working with our partners to source deals and select deals on a thematic orientation is a huge priority for us.
Your managers, the folks you work with, how many of them have put some of your money, and I'm curious how much, into senior secured loans? Right, because that's obviously private. It has been for since day one, but depends really on how widely they're distributed. And I ask simply because, again, the environment is rates are coming down. And senior secured loans are great, right? Collateralized, et cetera. Except when rates start coming down, then you may have a problem. So how are you thinking about that? What is your exposure?
So we have about 20% of the portfolio in both public and private credit. And so today, public credit is a slight majority of that exposure. But exactly to your point, I do think, for the past couple of years, the risk-adjusted returns in private credit, right, has been very compelling, right? You're able to generate maybe 200 basis points less than what private equity investors, the equity investors are forecasting, with much more structural protection, right? And so I do think, although although spreads have tightened, as you shared, the base rates have been so high that the all-in yield for the risk you're taking has been incredibly compelling, which is why pension funds, endowment foundations, a lot of folks have been, really increasing their share of private credit overall. I think it's doubled in a couple of years to 1.7 trillion or something. It's exploded. And so, and again, I don't think base rates will come violently, down anytime soon. And so still, even with, 25, 50 bip cut, the overall yield you're able to generate on where you sit in the capital structure of a company or an asset, it's still very compelling. But and so and just the last point there is, I do think on the direct lending side, so a lot of sponsored direct lending side, there's a lot of capital kind of flowing in there, and so even from the retail channels, and so
do you see any cracks there?
It's just I do think you're seeing a bifurcation, right? Those who are really committed to good sourcing, really making sure the covenants, will protect you, and also just the quality of your underwriting is bifurcating, a bit. And
but in some areas, covenants are
getting looser, for sure. Absolutely.
Okay. This could be a bit of a curveball, but when it comes to private credit, How do you think big banks are watching this development? Wait a minute. I know that banks have been sort of retrenching, and all these private credit guys are making all that money. We can come in on this. Deregulation, remember that narrative at the start of the year? Do you think banks will move?
Yeah,
or are they already moving?
Yeah, no, absolutely. I do think, there's a lot of conversations in conferences like the Milken Global Conference around the convergence of public and private markets, right? Just kind of the broadly syndicated loan markets against, these private credit behemoths that are, really competing sometimes for the same clients, right? And I do think private credit managers have now reached a scale where they're now able to serve, kind of a much larger, client base than they, were. Historically, they were serving much more the middle market, smaller companies, but now they're going up market, and it's one of the big, questions at hand. Some borrowers prefer, kind of the broadly syndicated loan public markets. Others, the private credit markets. But I would say, each side would tell you kind of the benefits of their of their product set. But anyway, it's unclear. It's unclear where market share will ultimately end up. But there are, plenty of opportunities.
Yeah, so when you say public and private credit market conversions usually means something positive to me, but that's not positive for the private credit guys, because public side is coming in, and borrowers are private borrowers are actually getting more options.
Well,
so give me a better term.
It's a word with another that starts with a C as well, and that's competition.
Yes,
is what we're talking about here.
Absolutely, absolutely.
What I find interesting is, on the public side, I think banks could get a big leg up pretty soon, maybe early next year, because Michelle Bowman at the Fed, right, is looking at these new regulations regarding capital requirements and buffers, right? And I just saw a report last night, right, that what banks are going to end up having to stash away for a rainy day is probably going to be a lot less than what was originally proposed under Basel III Endgame. So they're probably looking forward to that. But anyway, listen, you're out here in Asia. You were part of the Milken Conference, obviously the Asia Summit. How do private markets out here look to you?
Yeah, and so again, I think we chatted about some of the mega trends that we are really pursuing at TMRS, and I do think the Asia story kind of asymptotes, quite well with many of these trends that we're focused on. Just on the digital transformation side, obviously Asia is home to the largest digital consumer base right in the world, and so the different opportunities, to monetize. And again, I think the LLMs have, been won by the U.S. and China, perhaps. But I do think on the app layer, are there opportunities to provide digital consumers in this region with the slightly more hyper-localized versions of the apps? I think there's great opportunity there. And just on the healthcare side, I think Asia will welcome almost 500 million new people to the 60-plus age kind of cohort by 2035, and just the need for just higher quality care at lower costs, is paramount. And so there's just a lot of opportunities, just kind of on the provider side. Even Singapore is emerging as a biotech hub as well. And so I do think there isn't a monopoly on just kind of great companies and ideas. And so I do think Asia will share in some of these themes that we're looking at long term. The reality is the majority of what we're looking at does reside in the United States, right? We do have a slight home court advantage being based in Austin, Texas. But, I think institutional investors would be making a mistake not to spend time here and really learn the region, partly because global companies headquartered in New York, in London, and these places, some of their highest growth revenue bases sit here in Asia. And so it's not just about investing in Asian-based companies. It's also about understanding the end markets of many of the global companies, institutional investors are invested in. And so I do think, while the beta story of Asia, it's been a bit mixed, of recent times, but I do think it's imperative and important for institutional investors to spend time here and to really learn these markets. As we all know, it's not a monolithic market. It is incredibly idiosyncratic.
Yeah.
It is a constellation of economies, of demographics, of technological kind of advancement, and geopolitics. And so I do think it's really important for investors to come and spend time here.
Well, I was glad to see that you're out here, beating the bushes and also wearing out some shoe leather. I think it's a great thing. Yep,
Yeah.
Great to talk to you. Thank you
Absolutely.
for dropping by. Safe travels. Have a great trip, and see you again very soon.
Thank you.
All right. We've been talking to Yup Kim there, CIO, Chief Investment Officer of the Texas Municipal Retirement System, here with us at the SGX. And, of course, he's been down at the Milken Summit Asia as well. We're going to take a quick break as we tail out. A look at how Japan is shaping up ahead of the Open. We are less than 8 minutes to kickoff. We're handicapping what looks like a pretty steady start. Dollar yen at 147.14. The yield on their 10-year JGB at 670 thereabouts. We're back in 2.
U.S. markets were up across the major indexes in Thursday trading, despite a government shutdown for the last 2 days. Looking ahead to U.S. markets on Friday now, Wall Street will have to trade without the latest monthly jobs report, which won't be released because of the government shutdown. But there will be some economic data released, including global services PMI, a key indicator that measures the health of the global services sector. And finally, Taylor Swift's 12th album, The Life of a Showgirl, will be released.
morning, everyone. You're watching Squawk Box Asia. I'm Chery Kang in Singapore.
Good morning, folks. I'm Martin Soong. Let's get right to your headlines this hour. Asian markets are working with yet another record-breaking finish on Wall Street overnight, fueled by the AI trade that overshadowed concerns about the U.S. government shutdown, now into day 3.
The markets may be taking the shutdown in their stride for now, but how long the shutdown lasts is the bigger problem. Treasury Secretary Scott Bessent admitting it could hurt the economy and blaming politics.
There could be a discussion, but this isn't the way to have a discussion. Shutting down the government and lowering the GDP.
And he's got his fingers in everything from film to print to sports. We're going to sit down exclusively with Todd Boehly, the CEO of Eldridge and co-owner of fabled sports brands like the Lakers, the Dodgers, and Chelsea FC.
No trade in South Korea this morning, but these are the opening numbers. Let's take a look at Japan and Australia. So we've got the Nikkei 225 higher 0.4% and ditto for topics. ASX 200 is actually not catching any bid here. So very small moves coming through. I would imagine it's really the cautious open that we are seeing after that AI-driven rally. You rally and then you sort of sit back down and take a look around and what's going on around the world. I guess that's what's happening here. Quick check on shares of SoftBank Group after OpenAI finalized a secondary share sale to a consortium of investors, including SoftBank, bringing its value to $500 billion, and shares are higher by 1.6%. And Martin, it's really all about that OpenAI valuation, $500 billion US dollars. And I think it's really that optimism. And then I think people are kind of fearing right now, okay, so we're at record high levels. Do we need to take some money off the table, or am I going to shut out of further rally down the road? So I think that's really
and that $500 billion happens to be how much Elon Musk apparently is worth right now. Anyway, look, all week long we've been in and around the Milk and Asia Summit here in Singapore, and we've been talking about credit availability, both public and private, also possible disconnects between some valuations and also reality. Let's get to a very special guest who knows a thing or two about credit and has also built just an astonishing portfolio of pretty diverse companies, including in sports, in tech, in asset management, plus in media. Let's bring in Todd Boehly, Chief Executive Officer, CEO, Eldridge Industries, also the chairman of Eldridge, and as we mentioned, in town for the Milk and Asia Summit. Todd, great to see you and a pleasure having you on the show. And first off, I was going to ask you whether you're also in town staying on for the F1 race on Sunday. But first off, congratulations. The Dodgers, 8-4 over the Reds, are into the NLDS 13th year in a row.
Yeah, we're pretty excited about it. The team certainly seems to be gelling at the right time right now. So they're coming together, and our starting pitching is really tremendous. And, you know, our Japanese superstars are really stepping up and, doing a great job for us.
Absolutely, including Showtime, which we'll get to in just a bit. And I got to ask you, right? It is going to be 2 years back to back. We haven't seen that for quite a while.
It's been a long time.
Yeah.
Yeah, obviously that's what we're rooting for. Yeah. You know, if we could predict the future, it would be, there'd be lots of ways to express that.
Yeah.
But we're excited about the way the team's playing and the way they're gelling. And, you know, I think they now have a lot of experience, and they know that the next 4 weeks or so is really, what really matters, why they do this.
Indeed, and Phillies are up next, right? So we'll see what happens in that game. So, listen, MLB, NBA, the Lakers, in town, you've got F1 happening. It's growing, it's exploding as an international sport, right? Any interest in that at all?
Absolutely. I think the top brands are things that, we have lots of interest for, and ultimately they are the ones that, we believe in very much, because, I think the reality is that, there's very few teams that are up there in the very rare air. And all the F1 teams are certainly, up there. F1's done an amazing job expanding their footprint, going global. the American fan base was non-existent not too long ago, and now there's a giant following.
Yeah, I got to say, one of the newest teams, I think we'll see this next season, right? Cadillac. One of your buddies owns majority in that team. Are you part of that as well, or about to be part of it?
I'm partners with Mark in lots of different things. So our goal is to really align our interests and build something big. So that's what we've been working on.
So that's a maybe?
Yeah, that's a maybe.
Okay, we'll be watching.
I was actually talking to 6th Street on the sidelines of Milken Summit. I feel like sports investing has come a long way, sort of evolved, and a lot of PE involvement, a lot of sovereigns involvement. Why do you think it's changing? Is it because it's just getting so expensive that even the deep-pocketed billionaires having a hard time, and maybe they need layers, they need partnerships? Is that what's happening?
I think it's really simpler than that, right? The professional asset managers follow the asset flows. And as more and more money has been allocated to sports, headed to sports, focused on sports, you have the name, image, and likeness, which is creating revenue opportunities for athletes that were non-existent not too long ago. And when you think about the contribution that has come from NIL alone over the course of the last couple of years, this is hundreds and hundreds and hundreds of millions of dollars that are being put into the system, in order to develop a better team. I mean, the kid from Vanderbilt this year, Vanderbilt's playing good college football. He ended up, basically suing the NCAA and getting eligibility and got $2 million for it.
Diego Pavia.
Yes.
Is that the guy you're talking about?
Yes.
Yeah. What are you reading in terms of the fandom? How do you read the monetization of fans out there in 2025? How has it evolved? Because I believe you once sort of compared owning NFL to Netflix. Is that changing, and are you evolving with the fans right now?
Well, I think if you think about what these brands mean and how many people care about them, and you start to think about how do we allow those fans to get even closer to the team, the technology is going to allow for that. Right, so if you go back and think about the evolution of the revenue model of a team, right, it was first about selling tickets, right? Then it was about selling tickets and food. Then it was about selling tickets and merchandise. Then it became, selling tickets, merchandise, and radio. Radio then became TV. Right, TV then started to include gambling and gambling sports stars, where you're using the intellectual property in order to further the brand in one way, shape, or another. And so I think as the revenue models continue to evolve, the old ones continue to stay in place, and the new ones are just continuing to stack more and more revenue, on these leagues and on these teams.
What I find sort of amazing and also brilliant on your part is that's exactly how you're invested, right? In sports, up and down the value chain, whether it's stadiums to ticketing to the teams themselves. But looking forward, though, I've heard you talk about what you're expecting, how you're expecting this all to evolve, and you're thinking that probably in the next 5 to 10 years, maybe sooner, right? Because of technology, because of AI, right? The way that viewers or participants or just the public, right, experience sports is going to change very much, right? They're going to be able to, it's going to be less about viewing, more about experiencing, and I mean that sort of almost tactically as well, right?
Well, I think the experiential economy is just continuing to grow. I mean, if you look, like in Battersea Park this year, right, they did an immersive Grease show where 70% of the women that went to the show were dressed up as pink ladies. 50% of the men were dressed up as Thunderbirds. So you basically had this choose your own adventure as you walked onto a physical set. You could get up and dance with the actors. You could dance with the band. You could go have your dinner at the Frosty Palace. And so I think these interactive experiences,
and there's AR, VR as well, right?
100%. Yeah. Right. So the ability to feel something different, right? I mean, Team Labs is doing such a good job as they continue to build out these immersive experiences, and you've got, you know, the Aya and the House of Hype and all these places that, you know, are really adding to the experience. And you think about blending those elements with intellectual property, whether you're at a sporting event or you're at, you know, a Greece immersive show. You know, this is where this is all headed.
Talk to us about your media bets. A24 are garnering a lot of attentions, and you know, it's really the blending sort of, I don't know, traditional publishing with film production. What kind of metrics are you using to look at some of these undervalued media assets right now?
Well, I think when we look at metrics, right, we're looking at, a lot has to do with the size of the brand, right, and what brand are we, you know, acquiring, and how do we think about where that brand can go. You know, as it relates to A24, right, that was a brand that, you know, Daniel Katz and his team started from scratch. Right, and it's only, you know, 2012 that business got started, and now it stands for excellence in independent film and TV creation. And so I think that, you know, the bets that we're making are really ones with owner operators. Right, we love being partners with our operators, because, you know, that generally means that they're more fearless about the evolution and the change. And in the media world, we're seeing change happen so fast, right? Because content production prices are going down, special effects prices are going down. All this compute is changing, you know, the cost of goods. And if it's changing the cost of goods, then you start to wonder, like, who's still relevant, right? And, you know, if you're not in the business of creating intellectual property, if you're not in the business of having a relationship with a consumer or a subscriber, right, are you in no man's land if you're a middleman? So I think the evolution of, you know, the content creators getting closer and closer to the content consumers, you know, that's a journey that we've been on for a long time.
And because of the disruptions that you just mentioned, there is consolidation, a lot of M&A activities. Are you looking at any of them right now, or any more?
Yeah, I think in the media space, you know, I think we're really excited with continuing on the path that we're on. Whether it's the live assets like the Golden Globes or New Year's Rockin' Eve or South by Southwest, you know, coupled with the authoritative, you know, kind of assets like Billboard and Variety and Hollywood Reporter, you know, and then of course the film and TV production. You know, I think we're adding to our position in some of the live experience stuff. You know, we're continuing to believe that the opportunity to grow, you know, management capabilities, because the other thing that's happening is these, you know, leading celebrities are having, you know, very big businesses that they're building on the back of the fact that they have a very valuable marketing asset, right? So, you know, if you think about, you know, what's going on, and, you know, these businesses like, Bieber's wife just sold to Elf, right? She did an amazing job, you know, coming up with a company, growing it, and then monetizing it. And what they have, you know, at their an asset is that they have this massive following, and that following is really marketing value that you can put, you know, kind of dollars and cents around as you think about, you know, how are you going to build stuff.
Indeed, yeah, scaling your own personal brand, I get that. Look, excuse me, I'm a sports fan, so I want to get back to sports, okay? The Dodgers, when are they going to be worth $1 billion?
Well, they'll do revenue of $1 billion. They're worth well more than $1 billion, right? So they'll be one of this handful of teams that does over $1 billion of revenue.
This year, you think?
Yeah, absolutely. We just had record attendance. You know, we've got just amazing fan base, you know, and we've got a global following now. I mean, you know, the Japanese market wakes up and has breakfast with us every morning.
Yeah, and you know, the Japanese press corps, man, I mean, they must be just probably take up half the seats in Dodger Stadium, right? So, and I want to get to this point. You mentioned your 3 stars, right? They're Showtime, Shohei Ohtani, right, who's a global sensation and phenomenon. Yoshinobu as well, right? And then your rookie Sasaki, the monster, right? And I don't know, we'll see how he does in the playoffs.
He did great last night.
I saw it, yeah. All of them were stars in their own right. back in Japan, playing in their professional league, right? Weren't making that much money, really. They managed to get over to the U.S. and MLB. Boom, Shohei Ohtani, $700 million 10-year contract. It looks like there's not just a lot of talent over in Japan or maybe even Korea, right? But also value, don't you think?
100%.
Yeah.
You know, I think our guys are big believers in the fact that these sports are just going to continue to go global. You know, and I think if you can continue to find, great talent all around the world, because there's nothing like sports as a meritocracy, right? There's no, kind of sugarcoating it. You're just focused on getting the best players, right? Building the best team. What makes the best team? What's the culture of winning? Who are your captains? Who are your leaders, right? These are all the questions that you need to be able to answer, to be able to show that you got a chance, right? Because in the end, we're just playing odds, right? And getting a team, one of the things that brought Chelsea together so nicely over the summer, right, was they were on the road together for 5 weeks, right? So they lived in Philly, then they lived in Miami, then they got to live in New York at the last part of the Club World Cup. And that energy in New York really helped carry them through the end of a 5-week-long trip on grind. But what it really did was bring the team together.
So on Chelsea, right, and a lot of our international viewers are going to be tuning in for this part, right? Obviously, new manager yourself, new owner yourself, new manager as well. Roman's gone. Jose is gone. He's been talking about the way the new ownership yourself have been building up Chelsea. I mean, under Roman Abramovich, it was like top dollar for the best players. You've taken a more sort of gradual approach, right? Not quite top dollar, but younger players, and you develop and grow them. How's that been working out?
I think we've invested in, a tremendous young team. And I think if you see kind of how we're thinking about the future and what we're building, we expect it to be very sustainable. And we're now having success on the pitch, and we're back in Champions League, and we won the other night. And so I think we're, evolving into the team that, we're excited about becoming with, great young players that are going to be together for a very long time.
And speaking of Chelsea, you've self-reported some financial issues to the football authorities. Talk to us about the issues. What are you doing? What is your conversation with the authorities there?
It was really simple. We saw some things that, we just wanted to make sure that, we indicated what we saw, and, we wanted to make sure that the FA and the Premier League and everyone knew that, we're coming in looking to have a very clean slate, and we're going to run this the way we run businesses, in the U.S. and around the world. So I think that was just something that we identified early and flagged it, and knew that it was something that we were going to contend with. And I think we feel really good about the process we went through, with the various authorities and regulators in the leagues.
So listen, someone like yourself, security is a priority, and you probably don't want to telegraph your itinerary, right? But I'm thinking after Singapore, Milken in the F1, right? And you own FlexJets as well, right? You're probably hopping on a Gulfstream and potentially heading down to Macau?
No. I'm excited to go check out Australia, spend a couple of days down in Australia, and then get back for Game 3 at Dodger Stadium in LA on Wednesday night.
Okay, I brought up Macau only because, right, and it's been a couple of years, right? The NBA has been shut out of China, and we remember why. We won't get into that, right? But I think coming up in a couple of days, we're going to have 2 NBA teams playing there, and this looks like it's the restart of the NBA in what is an absolutely huge market for the league in China. What do you think of that?
I think that sports is a great unifier around the world, and I think the NBA is in a unique position to be able to really build a global presence, given the nature of the sport and the fact that it's not that expensive to play when you're young. And it doesn't take a massive 50-person team to be able to field a squad. So I think there's real elements of the sport that make it extremely scalable.
But Todd, we would be remiss as a finance guy not to ask you some sort of hard-nosed questions on finance, right? 4 months ago, you were saying that IG bonds are probably not good risk, low protection, but not really great real yields. Long U.S. Treasuries, they look interesting. High yield is not paying enough. How are you thinking now?
Very similar.
Okay.
You know, I think we're seeing credit spreads at very tight levels. You know, I think we're excited about being capital solutions for you know, situations that we have the ability to unlock value. You know, we announced the $800 million investment from L. Catterton and, you know, into FlexJet, so we're going to continue to expand that. You know, we have our Metropolis business, which we're the largest parking lot operator in the U.S., and that's going really well for us as we continue to make parking frictionless. No tickets, no gates, no hassle, just drive in, drive out. Yeah. You know, and I think we see that as an opportunity to take friction out lots of different places, and that's our goal.
I've got a really geeky detail question for you, and I think we asked our previous guest about this as well. I know you're very big in terms of credit, senior secured loans, right? Safe, you've got collateral there, etc. The only downside potentially is when rates start going down. That's what's happening now. What are your thoughts about that?
You know, I think you're just riding a rate wave when you're investing in senior secured credit, and I think, you know, the reality is that if rates are coming down, then your funding costs should go down, you know, and your dollar margin could stay, you know, the same, you know, or even improve, you know, depending on, you know, kind of where the funding markets ultimately go, you know. So, but I think you're you know, just continuously, you know, kind of riding an evolving market. And one of the things I like about senior secured is, you know, you generally, you know, are sitting at the top of the capital structure, so it's just less volatile of a ride. Right, and you know, the math of it is pretty simple. If a LBO gets done at 10 times EBITDA and you finance it at 5 times, right, then long as the business is worth 50% of what a private equity firm just paid for it, you'll get your money back. Right, and this is all about kind of understanding the structure, you know, so you know kind of what risks you're taking, you know, because the reality is that, you know, these senior secured loans have a very long track record of performing, whether it's called private credit or public credit or liquid credit.
Depends on widely it's distributed, right?
Yeah, I mean, and it ultimately, you know, but the risk metrics are the same. Right, you know, it's just whether or not, and of course, as the secondary markets are growing, there's liquidity in all different formats, you know, and one of the greatest things about the country is the liquidity.
It's great to have you on. That was Todd Bowley from Eldridge Industries. Squawk is coming right back after this.
Good morning, Asia, Australia, New Zealand. 2-year notes had about a 3.5 basis point range high to low. 10-year notes, about a 4.5 basis point range low to high. Those are really small ranges. Volatility, whether you looked at price movement in the actual cash market or you looked at the options market from a option volatility standpoint, in either case, volatility was low. Plenty of volume, just not a lot of movement, as investors do understand, and they really weren't as aggressive as they normally might be because there's such a void of economic information to trade off of. Today, we didn't get initial or continuing claims, trade deficit. Tomorrow, we're not going to get the big September jobs report. However, we are going to get reports that don't go through the government. For example, we'll have the S&P Global and ISM PMIs in the service sector tomorrow at 9:45 and 10 o'clock Eastern. So there will be some new inputs. And, of course, we all know yesterday that we had ADP jobs because it's not a government-related entity or a compiler or distributor by the government. And that data proved to be very weak in terms of its description of the labor market due to negative job creation. And that was exaggerated a bit in the marketplace. It was one of the big reasons yields have remained, for the most part, at the low end of yesterday's range from a news/economic standpoint. The equity markets, once again, managed to close in historic record territory, so they certainly don't seem to be negatively affected by the closure. But ultimately, the government being closed in some of these key reports that will help us understand how the glide path of the labor market is stacking up to what the Fed believes the glide path is or will continue to be. That's really an important issue. The longer the shutdown, the more damage that it could do to the marketplace, but it's still a little early to tell exactly what that may be or how long the shutdown would last to be the catalyst for some of those negatives. Reporting from the CME HQ, I'm Rick Santelli, CNBC Business News, Chicago.
Welcome back. Finally, Friday, TGIF here on Squawk Box Asia. A quick reminder, South Korean markets are closed today. It's a public holiday up that side. Tokyo and Sydney, though, are in play. About 30 minutes, into trade. They are looking, well, Tokyo's looking pretty sharp, up 0.8%. Sydney is just above the line by a couple of points, but we'll take it. Now, in Japan, the Liberal Democratic Party, or LDP there, gearing up to vote for a new leader tomorrow, October the 4th. Various opinion polls showed that among the 5 contenders, 2 are emerging as the front-runners to be LDP president, with Agriculture Minister Shinjiro Koizumi and former Economic Security Minister Sanae Takaichi pulling ahead in surveys. All candidates are going to be vying for a total of 590 votes. The opposition parties are not expected to be able to band together with a prime minister candidate of their own. The new LDP president will likely get elected prime minister despite its coalition with Komeito lacking a majority in parliament. We'll have post-election coverage with CNBC's Kaori Enjoji live from Tokyo. It's coming up on Monday, so you're certainly going to want to stay tuned for that coverage, her coverage. Let's go south now, Southeast Asia. Indonesia and the European Union, EU, last month finalized their long-awaited trade agreement that aims to boost investment in key sectors, including EVs, electronics, and pharmaceuticals. JPL, you managed to just talk to, in fact, Indonesia's deputy trade minister. Did he manage to put more flesh on the bones of that deal?
Well, this is one of the things we actually talked about when we spoke at the sidelines of the Milken Summit, actually, just the other day. Dia Roro Estiwidia Putri is the vice minister for trade. I know it's a bit of a mouthful there, but I mean, also a very young trade minister, Martin. But it's one of the things that they said was Indonesia's push to try and widen and develop more trading partners, including the EU. Now, if you recall, Martin, we also discussed one interesting tenet, or one interesting detail actually in the trade deal, which means that we'll see duties on European car imports into Indonesia actually drop to 0 within 5 years. But the European Union did say that if this is done, actually, that means it will pave the way for them to do more investments into downstreaming and also perhaps EV activities in Indonesia as part of it. So she actually framed this as a bit of a win-win situation, but it also goes back to those questions that Chery actually raised, is that did Indonesia give up too much with regards to these trade deals that they've been signing? And on one hand, you want to uphold the principles of free trade by giving out more of these, by liberalizing more of these, but you also want to make sure that certain vulnerable industries are protected. This is one of the things that we actually discussed on the sidelines of the Milken Summit, and this is what she had to say with regards to the EU trade deal and also the balancing act that they'll have to conduct when conducting and trying to ink these free trade deals with various partners. Here's what she said.
We're focusing a lot on energy transition, green energy generally. We're talking about human capital development, right? And so when you speak about how the European Union can contribute better within these industries, it would come off as a win-win situation. Yes, we're giving them the markets for their cars, for example, but we're also open for their investments, particularly within the downstreaming kind of industrialization that is currently one of our focuses in Indonesia right now as well.
And I think this also alludes to the balancing act, the tricky balancing act of creating these free trade agreements and balancing trade, because on one hand, they feel that to get to the trade agreement with the United States, the 19% tariff, maybe you gave up a little bit too much. That's what some of the critics say. But at the same time, there's also the idea that, there is a need to also safeguard and protect some of the vulnerable industries. How do you balance that as a Vice Minister of Trade, making sure that you can maintain free trade principles, but at the same time also make sure that vulnerable sectors continue to be at least safeguarded from unnecessary risks?
Yeah, I think this is a situation that a lot of the countries are currently facing, right? Every country will always have national interests. There will always be national interests in terms of what they're trying to prioritize to better develop their country, what kind of things they'd like to achieve going forward, right? I talked about the downstreaming industry as well. We're not only focused on, for example, the energy sector, because there's a lot of talks on EV, right? And how we can have like some kind of electric vehicle or battery hub in which we can then export also to the world. But there are other kind of interesting sectors, including that of the fisheries. We're talking about seaweed and how seaweed is already being downstreamed to many different products in Indonesia, which then are exported to the world. Seaweed can also be bioplastics, right? These are biodegradable solutions for the current climate problem. And there are many other downstreaming practices that are currently undertaken. Cocoa, just an example, we're also producing chocolate. We have amazing quality chocolate, high quality chocolates that are currently exported to the world as well. And there's a growing demand for this. And so understanding that there are these potentials, our interest is we want to downstream. The interest of the international market is, well, we want to trade, right? And so we're trying to do both. And through all of this, what's also important is making sure that this creates jobs. This gives us a positive signal to businesses that are in Indonesia, gives a positive signal for the investors coming to Indonesia that, look, there are these potentials and Indonesia is open for this kind of collaboration going forward. And again, because we are not living alone in the world. We are living with many other countries across the world. And so we have to continuously engage with one another. And that's the position that Indonesia is currently taking.
So in some ways, Martin, the trade tariffs actually has forced Indonesia not just to find new trading partners to offset the impact of the tariffs, but also to look deeper into their products and try to downstream and see if downstreaming can unlock new potential in some of the legacy products they have, such as seaweed, such as cocoa, for instance, and seeing if they can extract more and actually sell it into new markets, actually. So the task is kind of tall for them. It seems that this is something that they'll have to continue to dig into. But again, this is the mandate right now in Indonesia, try to find as many trading partners and try to get as much out of the existing products they're exporting to make sure they can recognize more value. But again, this is a very tall task, and we'll see if they're actually up to it in the coming months.
Okay, we'll be watching. Excellent as always. Thank you, JP Ong there. Now, talking about seaweed and other food, making me thirsty. Japan, where salaryman beer is about to run dry, and, well, everybody is nervous. That's right, Japan is just about to run dry of Asahi Super Dry after a major cyber attack killed production. David Suzuki at Kikutora Special Roast standing by to talk about the rash of ransomware attacks in Japan recently. After this. Welcome back, TGI Friday here on Squawk Box Asia. So it's almost the weekend and thinking about popping that first Asahi Super Dry, right? Well, if you're in Japan, though, you could be out of luck, because earlier this week, a massive cyber hack stopped pretty much all of Asahi's production cold. And now Lawson, the konbini giant, warning that the whole country could be left, well, high and super dry, as in no stock, nada. So looks like Asahi got hit by a ransomware attack, but we don't know who's responsible or if Asahi is going to take the hit and pay the ransom. There have been a few of these ransomware attacks in Japan recently, which has people asking how cyber safe otherwise high-tech Japan really is. The publishing arm of Kadokawa, the conglomerate, got hit by a similar attack last year and reported an extraordinary loss of more than $16 million related to the ransomware attack. Let's get more and bring in David Suzuki, CEO at Kikutora Special Risks, also the founding director of Black Panda Japan. He joins us now live up in Tokyo. David, great to see you and a pleasure having you on the show. Just to get it out of the way, is Kikutora involved or handling this Asahi attack at all?
No, neither Kikutora nor Black Panda is involved in this particular incident.
All right, good to know that. But, you know, there's been this rash of ransomware attacks on companies in Japan recently. It's a little out of the norm. Why is this happening? Do you have any sort of sense?
Well, I think one thing is kind of the rise of generative AI, which has effectively broken the language barrier. I mean, previously, I think a lot of threat actor groups gave Japan lower priority because of the language barrier. But now with generative AI, language is not an issue. So I anticipate a spike, actually even more than we're seeing now, increasing frequency of cyber attacks on Japanese companies.
Well, so this is sort of the dark side of AI, and shows that AI, much as it's vaunted, can be a double-edged sword.
Correct. Yes. So basically, you know, what we're seeing here is, AI lowers the barrier for attackers. You know, we've seen deep fakes, automated phishing, rapid malware iteration. But fortunately, it also empowers defenders with anomaly detection, predictive response, and other capabilities. So the decisive factor is who integrates AI into their doctrine faster. The attackers or the defenders?
Yeah, Black Panda has its origin story in handling physical ransom cases. Now we're working up to, of course, ransomware cases, right? In a situation like this, if it were to be brought to your attention, if you were to take it on, what would you be advising corporates that have been attacked in this way to do?
Well, very important to have an incident response plan in place. If you don't have one, it's still okay. It's not too late. We can effectively come in, and start investigating the incident, containment of the breach. We can conduct things like, root cause analysis to identify how the threat actors got in, try to plug the security gaps that way. Determine whether or not there was data exfiltration, and also just on the more human risk side, actually engage with the threat actors in a risk advisory based negotiation.
And, in most cases, or does it depend case to case? I don't know. You tell me. How does it go? Is the advice, look, just pay up and get them off your back, or?
Basically, we try, first thing is to try and contain the breach, and then create conditions where the digital forensics team can conduct their investigation in a stable environment. At the same time, through engaging with these threat actors in sort of a negotiation advisory role, we can collect intelligence on who they are, or who what sorts of TTPs, techniques, tactics, and procedures that they employ, and gain intelligence on who these folks are. At the same time, if in the unfortunate event that a victim had already paid a ransom, we have the capability to trace any sort of payments, which are usually made in cryptocurrency. We have the capability to conduct blockchain analytics to try and identify where the funds went, and then work with legal counsel and/or law enforcement to try to claw back those funds.
Yeah, and this is an interesting question. I mean, in most cases, do companies that actually pay up because they're able to trace the crypto, are they able to get some, if not all, of that money back, or not?
No, in some cases, yeah, victims are able to recover some of what they've unfortunately inadvertently, or I shouldn't say inadvertently, what they were kind of pressured into paying. But we can't recover funds in all cases, unfortunately.
All right. Dave, I've got to ask you, just a couple of seconds ago, we were showing viewers a graphic, the number of cyber attacks in Japan. I think this was for last year, all of last year, 2024. That's about 222 of them, which is up about by 12 cases, I think. What does this say about corporates in Japan and how cyber secure they are or not? Because I mean, usually when you think about Japan, it's Blade Runner, or Tokyo at least is at least, right, super high tech. But I mean, if these cases are happening with this kind of in this kind of volume, what does it say?
Well, I think unfortunately, Japan has gone through a long period of I shouldn't say unfortunately. Fortunately, Japan has been at peace for many decades, but that has made the general populace complacent. So no one thinks that they're going to be a victim of a cyber attack. However, the reality is Japan faces both targeted campaigns by state actors, cyber criminal groups, and others. But there's also these spray and play attacks that probe any publicly facing IT service. So there's a lot of random attacks. And what this means is that anybody in Japan can be a victim. I mean, nobody is safe. Everybody from mom and pop operations to global Japanese corporations are potential victims. So, a corner store can be a victim. Global financial institutions can be a victim. Critical infrastructure can be attacked. Cybersecurity policy in Japan is becoming more centralized, but there's still market fragmented oversight and uneven private sector defenses. And this all combines to create systemic risk.
All right, David, listen, it's been excellent talking, great value. Appreciate your time. Thank you. You keep safe, enjoy your weekend, and talk again very soon. I hope under, better circumstances. David Suzuki there from Kikutora Special Risks joining us live up in Tokyo. All right, still ahead, we'll talk about travel, move on to that. CNBC's travel editor, Monica Petrelli, is going to join us. And with a slice of her conversation with business jet maker Bombardier on the sidelines of the Milk in Asia Summit. When we come back in 2. Welcome back. Friday here on Squawk Box Asia. So Canadian business jet maker Bombardier is set to post third quarter earnings next month, and investors are going to be watching out for any impact from tariffs, of course. Now, CNBC's travel editor Monica Petrelli was down at the Milk in Asia Summit together with the rest of us and talked to Bombardier CEO Eric Martel. How's that?
You know, Marty, Bombardier is such an interesting company. So when you see in an era where a lot of companies expanding, pushing into new areas, even new sectors, Bombardier went the opposite way about 5 years ago. Jettisoned its rail units, stopped producing commercial aircraft, focusing just on business jets, saying we're going to do what we do best. At that time, it brought Martel, who had been a longtime executive, back into the fold. He's been at the helm since 2020. This seemingly working out very well for the company. Financials looking good, orders up, debt levels, that was a big issue, down. Then this pesky issue of tariffs comes about. Now, so far, the company, which is Canadian, has been able to avoid a direct hit because of the U.S. Mexico-Canada agreement. This was a trade agreement put in under the first Trump administration. However, still companies like Bombardier still quite worried. However, Martel putting on a brave face. Here's what he had to say about the issue of tariffs and his company.
Of course, as a company, but you said it. Our biggest market remains the United States. I think what's important to understand is there's been a free trade agreement in aerospace since 1979, even before the agreement that we know today. And you know, Bombardier is an example. Not only we're selling plane in the U.S., but we're creating a lot of jobs. We have 2,800 suppliers in the U.S. And in some cases, you know, if I compare to my competitor that are American, sometimes we have more U.S. content on our plane than you know, my counterpart in the U.S. So I think it's important to understand that. So I think at the end of the day, you know, common sense will prevail. You know, we do create a lot of jobs in the United States, either by our manufacturing footprint, our own manufacturing footprints, our suppliers, but also our service center that we have all around the U.S.
But has this at least made you think twice about perhaps exploring more business in other regions like Europe or Asia Pacific?
Yeah, no, clearly, you know, but our business is global. So biggest market remain the U.S., but we're selling a lot of planes in Asia Pacific, actually. It's been a growing demand over the last few years. Europe has always been solid. Middle East is very solid also these days. So we are a global player. We also have a defense division. We basically use our platform, modify them with some mission hours that could be American, could be European, and then we're making our airplane available for defense purposes, surveillance, communication nodes, different type of applications.
Now, Bombardier, formerly pushing into that military jet area a couple of years ago, it sees this as a big area of growth for the company, especially as tensions around the world continue to heighten. However, even this area not necessarily immune to exposure from tensions between Canada and the U.S. Martel earlier this year talking about when it became known that Canada was reviewing an order for 88 fighter jets that it had placed with the American company Lockheed Martin. He openly talked about worrying about whether then the U.S. might respond in kind by canceling an order for jets that it had with Bombardier. Now, I asked him about this yesterday. He said he reiterated his refrain that cooler minds will prevail, he opened. He also said that the two countries really need each other when it comes to aviation.
Yeah, and you know, on the business jet, commercial jet side, they're about to launch a new model, the Global 8000. Is that bigger, better, faster, or?
Yes, it's all of those things. Yeah. Global 8000. So I asked, this jet really making a lot of waves. It is said to be, by the company, the fastest civilian aircraft since the Concorde. Now, wow. It's capable of reaching speeds of Mach 0.94. Now, aviation buffs know that's not as fast as the Concorde. However, it is quite fast for a business jet of this size. Also, the range, 8,000 nautical miles. That'll get you from London to Perth, LA to Singapore. So, yes, it's all of those things. But here we are, October. I asked him, is this, you know, is it going to come this year as planned? This is what he said.
It's going to hit the market this year. So we're going through the final documentation of certification right now. It's basically an evolution of our Global 7500, but the airplane is going to be the fastest airplane in the world, will be the longest range in the world, and this is like a product that, is basically a replica of what you would find at the office or at home, as I said earlier.
We're hired as a transformation player. Is the transformation of Bombardier complete?
I think at the end of this year, we will be able to declare that the transformation we've announced 5 years ago has been completed. We pretty much, check all the mark of what we committed 5 years ago has all happened. Even a lot of things happened a year before. So now we're looking at the future to grow our services division. Our defense business is doing extremely well right now. So we're very optimistic about the future of our company.
So in addition to defense, the services, Bombardier also going hard on its after-service market. And Marty, it's interesting because the after-service market, this used to be like a selling point. Business jet manufacturers saying, buy from us, we'll take care of you afterward. But now, more and more, this is its own separate revenue-generating area. And each year, for the past couple of years, Bombardier is seeing bigger growth from this avenue.
They call it MRO, maintenance, repair, overhaul, right? But man, Mach 0.94, that's almost the speed of sound. I mean, how fast do you need to get to that meeting or to your private island? But anyway, yeah, look forward to that. Thank you. CNBC's travel editor, Monica Petrelli, there. And Monica's been busy. We'll have her exclusive interview with the McLaren CEO, Zach Brown, and also Haider Rafiq from blockchain firm OKX. They're both here, of course, for the Singapore Grand Prix, which is happening on Sunday. And they're going to talk about monetization and capturing fans through their partnership as F1 fever takes over this little island here. Tune in for that when we come right back in 2. Time check, it is 9 o'clock sharp, Hong Kong, Singapore time, and the Singapore market is joining Friday trade, the final session of trade this week, opening up a little bit on the soggy side, as you can see right there. I'm Martin Soong at the SGX. Let's get right to your headlines this hour. The markets that are open in Asia tracking that positive lead from Wall Street overnight. No trade over in South Korea, holiday there. Japan, though, is up more than 1% today, looking sharp as members of the ruling LDP head for a leadership vote tomorrow, October the 4th. EV giant Tesla's third quarter deliveries shot up as customers took advantage of expiring EV incentive schemes, those $7,500 EV credits. The stock, though, slipped. We'll ask industry watcher Carl Brower if we've already seen the high watermark for Tesla's quarterly sales. And it is race weekend here. We're talking about F1. It's possible McLaren could clinch the Formula One Constructors' Championship this weekend, so a potential party ahead for Team Papaya. We'll hear from team boss Zach Brown a little later this hour. Look forward to that. Let's get right to markets, show you how some of the smaller secondary markets are joining Friday trade. Singapore, as we showed you moments ago, looking soft, down about 0.2%. Kuala Lumpur is, sharp today, up better than 1%. Taiwan is up a still solid 0.4%. And the big markets, the big fellas, an hour plus into trade are looking like this, sharp. Tokyo's up at or near session highs, about 1 1/3 ahead. You've got Sydney up about 1/4% right now. U.S. Treasury Secretary Scott Bessent sat down with CNBC's CNBC overnight in the U.S., saying that growth in the U.S. could take a hit from the latest government shutdown. He also said the Trump administration will continue to support American farmers and China's refusal to purchase soybeans, hinting that an announcement could be made as early as next week. Here is part of that conversation. Take a listen.
Just to be clear, the spending cuts that occurred in the One Big Beautiful Bill were the largest in history, and we're not going to go back on them. That I came out from behind my desk and wanted to join the government to right the ship and get our fiscal house in order. We were left with a mess. It was the largest deficit when we weren't in a recession, weren't at war, and we are fixing the deficit. And there could be a discussion, but this isn't the way to have a discussion. Shutting down the government and lowering the GDP. We have a 3.8% GDP, and when the Democrats shut down the government, that we could see a hit to the GDP, a hit to growth, and a hit to working Americans.
We'll move on to trade quickly. I don't know, these never last that long. I don't think the market never looks much at the shutdown, so I figure, I don't know, 3-4 days, I think, when it's over. But can we talk, I don't think we've ever talked soybeans in terms of China, but this is a real issue right now. Our farmers are getting caught up in the trade dispute. Is there anything the president can do, or what do you expect to happen between the president and President Xi?
Well, there's plenty the president can do, and it's unfortunate that Chinese leadership has decided to use the American farmers, soybean farmers in particular, as a hostage or pawn in the trade negotiations. And American farmers overwhelmingly voted for President Trump, more than 90%. He loves the farmers, he loves them. We have great Secretary of Agriculture, Brooke Rollins. 3 of us were in the Oval yesterday, and you should expect some news on Tuesday on substantial support for our farmers, especially the soybean farmers. They've had President Trump's back, and we've got their back.
All right, so of course, remember China buying U.S. soybeans, that was part of the phase 1 trade deal under the first Trump administration. And reminder, China has still not fully bought what it promised to buy in terms of U.S. soybeans. Anyway, quick look at the dollar, other major currencies, how they're shaping up so far this Friday. DXY, top of your screen, heavily euro-denominated basket of half a dozen currencies at 97.85. Dollar yen at 147 1/3 or thereabouts. You've got the euro itself, the European Common Single Currency at 117.25, and cable 34.42. Let's bring in Max Castelli, head global strategy, global sovereign markets, also managing director at UBS Asset Management. He is in town for the UBS's 4th Sovereign Investment Circle Conference here in Singapore. Max, great to see you, and a pleasure having you on the show. And the funny thing is, a lot of people, there are probably a lot of the same people at your conference as they were at Milk in Asia Summit, and they're also probably staying for F1.
Yeah,
this weekend,
and there was also, I believe, a crypto coin conference or something, digital.
Yes,
absolutely. So we had I think clients took advantage of the fact that there are multiple events going on.
Indeed. So your conference, right, just wrapped up yesterday, right, Wednesday and Thursday. And we were talking offline a couple of seconds ago, and you were telling me that for a lot of the people taking part in your conference, geopolitics, including what is happening in the U.S. with the shutdown, was top of mind.
Well, geopolitics in a very broad sense includes a lot of different things happening around the world. It's definitely a big topic for investors. But I think what we are seeing at the conference is that maybe investors are becoming more used to this type of volatility in the geopolitical world. And actually, they are more focused to think about how to manage the portfolio, how to make it more resilient in the light of the volatility that can erupt. Maybe with regard to the shutdown, I think the impact on the market traditionally, historically, has been very small. If it repeats itself as it happened in previous, I think that there were 6 or 7 episodes similar to the one we are living now in the US. Normally, the impact is very short-lived, and at least from a financial market perspective.
And that's what most of the people at your conference
That's
are hoping?
what I heard from your colleagues in the US.
Is that what most of the people at your conference are hoping as well?
Yeah, we didn't really talk about the shutdown, to be honest. I think we were more focused. These are very investors, we call them long-term investors. They're very really focused about how things are moving over the medium-long term, because their portfolio investing decisions are not based just on the news of the day, but they're really based on the way they really look at performance in assets across various asset classes. And this year we definitely saw that there is a lot of focus on US dollar assets, a little bit of thinking about some diversification, which is a big topic for investors in general.
Yeah.
Also, the focus is very much on alternative asset classes, which remain a very strong strategic focus. But of course, the world is moving. The world is changing, the global markets are also changing, and the investor needs to adapt their portfolio. And that's the type of debate that we had at the conference.
So, Max, a lot of the people at the conference, right, were from sovereign wealth funds, were from pension funds as well. So these are massive pools of money, right? And most of them have sort of long-term liabilities.
Yes.
They've got that long horizon, right? What are they doing with the money? How much more is going into private markets? I'm curious, because they've exploded the last couple of years.
First of all, many of these investors have been enjoying a very good return over the last few years. If you look at the return between, let's say, immediately after the COVID crisis, the bad year, they have a return well above double digit. So we're talking about 12, 13, 40% return per year over the last few years, largely because they have a very risky type of portfolio. They are long-term, they can take a lot of risk, so they normally have up to 80% equity in their portfolio, 20% fixed income.
Equity as in public market equity?
Equity across both public market and private. Okay. A big trend over the last few years has been the rise of private markets.
Yes.
In the previous regime, if I may use this word, it was all about search for yield because of the low yield environment. Now with the yields being higher and expected to remain relatively high compared to where they were before COVID, the focus on alternative, it is much more about searching for macro hedge, for instance, a protection from inflation risk or from volatility. Think about gold and commodity at the moment, which is going very strong. It was a big topic at the conference. But as well, it's about investing in teams. Think about investing in real estate or in private equity on digitization, artificial intelligence. Very often, if you want to invest into new teams, like exactly digitization, normally the best route to invest is not in public market, but is via private market, because that's where the big story of growth in terms of company actually normally starts.
So interesting, with 2 wars going on at the same time, 2 major wars with tariffs flying around all over the world, and with a lot of other things happening geopolitically too. This strange alignment between China, India, and Russia at the SEO, I think, raised a lot of eyebrows, right? You would be thinking that after the feasting years for some of these people at your conference, the sovereign wealth funds and the pension funds, they might be starting to think about or worry about the famine part after the feasting. Is that part of the reason why they're looking at alternatives and hedges like gold?
I mean, gold is definitely an edge, and we believe that gold will continue to do well. I think the rise of gold reflects several factors. Geopolitical volatility is one of them. Concern about debt sustainability level. Think about debt level in the US, but also in many other advanced economies, like for instance in Europe. The third one is also.
I got to ask you: are they holding fewer dollar assets?
The short answer is no. The short answer is that the dollar is still a very dominant currency, and I mean in terms of asset denominated in dollar, both across fixed income and equity. But there is no doubt that events like, for instance, the attack against the Fed independence or attacks against the rule of law in the US has in some way, let's say, raised some eyebrows among investors. So many investors are asking themselves whether the US dollar has the same future as a safe haven, which has been the case for many decades now. So I see a lot of inquiry. The problem is that there are no many alternatives out there. Think about if you are invested and you have a portfolio exposed for 60, 70% to US dollar denominated assets, and you decide, that was one of the questions we debated at the conference, I want to take away 10% of that exposure. Where do I put it? Shall I put it? And the candidates which are very often mentioned are Europe, so euro-denominated asset, China, because traditional investors are very under-invested in China. When you take into account the size of China as an economy, is not reflected very often in long-term portfolios, so there is still room there for growth, and we have a positive view about Chinese equity at the moment, and the emerging market as well, in particular, I would say Asia. So in the end, this is still, I think investors are still digesting. I believe this is going to be an evolution over the years. But I wouldn't be surprised if there is more diversification away. Shall also not forget, US equity are pretty expensive from a valuation perspective. Good risk management demand for spreading a little bit your investment more broadly. So it makes absolutely sense, regardless of geopolitics and politics.
I mean, absolutely. The NASDAQ and the S&P both hit record highs yet again. It's something we're getting used to. It's been happening almost on a daily basis recently, right? And the market's now at, I think the S&P is at about, trading at about 23 times forward, right? But
this market very strong.
This idea of diversification, I'm curious. Pension funds, sovereign wealth funds, etc., characteristically tend to be pretty conservative, right? Large pools of other people's money. How much talk was there at your conference of alternatives like crypto, like stablecoin?
Okay, this is a big team, and I would define it as, let's call it AI/digitization.
Okay.
The way that we tackle this theme from when we talk to clients is that it's very broad, so you need to start thinking about different parts of it. We have the whole question about the use of AI in portfolio construction and investment. So basically the idea is that if we think about the future of any advisor, investor, or a portfolio manager will have what we call an AI agent working with him, who will help, for instance, in terms of data analytics or providing additional inputs that he can use in his investment decision-making process. That's one aspect.
Is it happening with sovereign wealth funds?
It is happening for sure in financial firms, and some sovereign wealth funds are more ahead than others, but it's definitely happening within sovereign wealth funds as well.
Okay.
The second topic is all about stablecoin. You know, this is also very much about the way stablecoin are developing. As you know, the Genius Act in the US, and this has given a lot of impetus to this trend. There is a lot of talk about what stablecoin and the rise of stablecoins means, for instance, for demand for US Treasury, which is another big topic. And then there is a third area, which is probably also very more interesting for financial institutions like us, which is the whole question of tokenization of assets. Basically moving assets from, like, for instance, real estate or even some commodities, money market fund, into a digital platform working across blockchain. This increases efficiency, you can trade much faster. So this is a big team. We debated a lot. And we think that we are just at the beginning of this trend, so it's very exciting.
So investing in AI, right? Sovereign wealth funds and pension funds, I mean, slightly different cycles, right? But I think fair to say that pension funds, sort of almost like insurers, right? Long-term liabilities. When you think about that model and you think about AI infrastructure, the actual hard stuff, the equipment, they seem almost perfectly matched.
Absolutely. Infrastructure is a good match for pension fund in terms because they are what we call income generator. They also tend to provide an edge against inflation. So when normal inflation rise, infrastructure yields tends to rise as well because they are indexed. For sovereign wealth funds, it's different. Sovereign wealth funds are more what we call no liability investors. They don't have to pay any pension. They have the ability by indirect towards the government. So they are the one who can really deploy capital with a very long-term view. They can take a lot of risk in sense of volatility, and that's why when you see the big deals around the world, normally you always have a sovereign wealth funds involved into it because they have the capacity and the investment appetite to do deals like that.
Yeah, I'm just curious, and we were talking about this earlier this morning. For sovereign wealth fund types, for pension fund types, etc., what are they thinking, looking into, let's take a slightly longer view, early next year, let's say, right? Because one of the things that's happening in the U.S. at the Fed, led by Michelle Bowman, is overhaul of financial regulations, right? The Basel III endgame. It sounds as though, or looks as though, I was just looking at a recent report, that the Wall Street banks are probably going to get what they want, which is lower capital requirements, leaving them with more money to lend out. So they're going to be probably pretty happy. Is that something that folks in sovereign wealth and also in pension funds are going to be paying attention to?
I mean, sovereign wealth funds will pay attention to any big trend which can create an investment opportunity. They're very much commercial organization, if I may use the word, looking at opportunities around the world and grasping them when they arise. I think the main trend that we saw among sovereign wealth funds is for sure there is a lot of focus. There is a little bit a trend toward becoming a little bit more regional domestic. So to deploy more capital domestically or across the region. I think it is also part of a trend that we are seeing around the world to be a little bit more domestic focus. The second one is that we see a lot of also collaboration across sovereign wealth funds, which is very interesting. For instance, we see a lot of growing flows of capital and also of human capital between, for instance, the Middle East and Asia, which is also part of the geopolitical movement that we see around the world. If you want to diversify more geographically, you want to create connection with regions which are more close to you. And the third one is definitely, as well as you said, about the use and the adoption of AI and digitization and the search for opportunity in that sector, because that's where they see the extra performance that the alpha that you can generate in the future.
I'm curious, as a banker yourself, right? How are you thinking about what's happening in AI now? Is this a bubble, you think, or?
In the AI, from an investment point of view, well, for sure, the tech stocks there is valuation are very high, but there is also a view that the capex, which is the big driver of this trend, can continue, and I think that's a requirement for this price to be maintained. There is a lot of debate whether this is going to translate into real productivity growth. And that's a big question mark. I am an economist by training. Ultimately, financial markets, of course, sometimes they can get ahead of themselves. But ultimately, the question is how much AI will actually lead to an increase in the growth potential in not only of the US, which is for sure in the lead, but also of other countries, think about China or Europe, which are also investing and moving ahead on AI. This is still a big question out there. We had a similar debate during the tech bubble in the early 2000s, in the internet. In the end, we know the internet had an impact on productivity. So probably the truth sometimes is always in the middle, right? There will be a positive impact. The question is how much, and will be this enough to justify the current valuation in the tech stocks? But when we think about that, we always think investors should think about diversification. Also, if you're a passive investor, you are exposed automatically to tech stocks, which really represent diversifying a little bit more across market and across region makes sense in this type of environment.
Hedging your bets, understood. All right, Max, grazie mille. Thank you so much.
Grazie
it's great to see you.
Take
care.
Much.
Have a great weekend. Come see us again soon.
Unfortunately, I'm flying tonight. I just go to see very quickly today a little bit of Formula One, and then I fly back home.
Safe travels.
Thank you so much. Thank you. Bye-bye.
Max Castelli here, UBS Asset Management. We are back in 2. Welcome back Friday here on Squawk Asia. So global trade tensions still in focus after U.S. Commerce Secretary Howard Lutnick proposed that Taiwan locally manufacture 50%, half of the chips needed by the U.S. Taiwan's top negotiator said the proposal was not discussed in trade talks with Washington. Global Foundries Chief Executive Chairman, Thomas Caulfield caught up with our colleagues stateside to talk about domestic production and the need for balance. Listen to this.
Look, I think every business, this is about businesses, not governments, every business gets to choose how they want to satisfy their customers, what are their business and financial models. You know, for GF, I can speak for us, we're ready to continue to build out our scale and manufacturing in the U.S. for all the right reasons that the U.S. government, the Trump administration, Secretary Lutnick, we're trying to bring domestic manufacturing back to the U.S. Why? For economic, supply chain, and national security reasons. We cannot have one of the most important resources, semiconductors, and not have an indigenous capability.
Is the effort right now more effective than it was under the CHIPS Act?
No, I think you really have to parse these two things as being complementary. The CHIPS Act was about creating economic tools or using economic tools to make sure we could put capacity in the U.S. at scale and globally competitive, because other regions of the world give those types of subsidies. The tariff proposal is really about lifting and shifting the demand to fill that capacity. So there's no sense building capacity if the demand's not here. And this administration, with Secretary Lutnick, President Trump, are trying to drive using economic tools to drive the demand here as well.
So you think both were legit, in a sense?
Both legit.
The CHIPS
both
Act
are
made
required.
sense, and these tariffs make sense.
If you believe, and I don't know anybody who doesn't, that for national security, supply chain, economic security, we ought to be doing more semiconductor manufacturing in the U.S., then these are the tools you need to go make that happen.
The government obviously is becoming very involved in this industry. You're saying, yes, businesses need to make their own decisions how to satisfy customers, but do you think the government is going to turn to you, try to take some kind of an equity stake? Have there been discussions?
Look, I have met personally with Secretary Lutnick numerous times to reestablish our CHIPS funding through the program, to talk about some of the things we need to accelerate, make our programs bigger and better. Not once did the conversation come up about taking an equity stake.
Are you seeing share gains right now in the foundry business?
What I think we're seeing is our customers recognizing that the globalization that's been going on for the last couple of decades, some of that needs to be pulled back, and creating a more balanced and resilient supply chain and bringing the U.S. into that mix is important for them. And we're here for them. We will build at the rate and pace that they decide they need to bring domestic supply home.
All right, looking ahead, we've got CNBC's The China Connection coming up top of the next hour. Mandy Drury is along to tell us what is coming up, man. Good morning.
Yeah, hey there, Marty. Well, of course, we've got the big OPEC Plus meeting coming up on this Sunday. And even though we've got oil prices sitting around 4-month lows, guess what? There are some rumours out there in the market that we could see a big and surprising oil supply increase, which is really incredible when you think about where oil prices are sitting. Why? Well, it's all political, isn't it? OPEC Plus doesn't want non-OPEC to get more market share. It's all about blocking market share, isn't it? So we'll see what happens on that front and what the impact could be on oil prices, of course, come Monday morning. We're also going to be doing something a little bit fun because it's Friday and we're finishing up on a high. Jack Dwyer, the CEO of Infusive, is going to be joining us to talk about Chinese luxury buying because, of course, we're smack in the middle of a super long, extended Golden Week period. So are they going to be out there buying? Because what we're seeing is an evolution in luxury buying by the Chinese consumer. Because yes, they've been an absolute global force. I mean, you go to Australia, all the stores like Gucci and Tiffany, they're all targeting the Chinese consumer. But they're changing, right? They're more sophisticated. They want more experiences. There's more nationalistic buying as well, more domestic brands that they're focused on. So we want to talk about, from an investment point of view, how to sort of ride that new trend.
All right, looking forward to it all. Excellent. Mandy Drury coming up on CNBC's The China Connection a little later on. We'll take a quick break. We'll get to Hong Kong market open in China markets after this. It is 9:30 Hong Kong, Singapore time, so get up and go for China as well as Hong Kong markets for the final session of trade this week. Looks like a nice day shaping up in Hong Kong. Live pictures from our Bureau of Hong Kong Harbors. Get to the numbers, though. How's Hong Kong opening up? Seconds out. Not so good. Off to a negative start, as you can see right there. Let's break it down and take a look at the heavyweights on the Hang Seng. Incidentally, of course, China, don't forget, is out of play for the long Golden Week holidays. But the heavyweights in Hong Kong it's kind of a mixed, patchy picture. You've got HSBC down about 1.33%, CCB in the negative as well. But the other names on your screen, platform giant Baba, we've got Tencent, EV maker, well, actually fridges to phones to EVs now. Xiaomi is also nicely in the money. Talking about EV makers, let's check out some of the bigger names. Xpeng, actually all of them are trading down today, as you can see right there, including biggest of them all, BYD off 1.5%. Meantime, rival Tesla surprising investors with a record number of deliveries last quarter. The stock, though, still skidding. TSLA 5% in trade overnight, more than that, in fact, 436 even last done. This comes as consumers rush to buy more cars ahead of a $7,500 EV discount or a credit expiring just a couple of days ago. CNBC's Phil LeBeau has the full breakdown. Take a look.
Tesla posting its best quarter ever for deliveries, easily blowing past analysts' expectations. Last quarter, it delivered 497,099 vehicles, more than 100,000 above the Q2 total, and a huge jump from the Q1 deliveries of just over 336,000. So what happened? Two things. First, the expiration of federal EV tax credits in the U.S. likely pulled forward sales. How much is unclear. Second, Tesla sales in China have been improving, especially after adding the new Model YL to its lineup. The question now is how much fourth quarter deliveries may slow down due to less demand for EVs here in the U.S. The other big story for Tesla last quarter, record energy storage deployments. It has now deployed more energy storage in 2025 than it did all of last year, when 31.4 gigawatt hours was a record high. What remains to be seen is how much tariffs may have impacted margins when it comes to Tesla's energy storage division. We will get that answer and other key metrics when the company reports its Q3 financials after the bell on October 22nd. Phil LeBeau, CNBC Business News, Chicago.
Let's keep talking. Bring in Carl Brower, executive analyst at iSeeCars.com, joining us live. Carl, great to see you again. Always a pleasure having you on the show. So the TSLA, the Tesla delivery numbers were really strong, but I mean, this is just front loading, right? That's pretty apparent and obvious. When is the payback going to be?
Yeah, we're going to see it the next 3 months. I think the fourth quarter for EV sales in the U.S. is going to be pretty brutal. You had GM up over 100%. You had Ford up about 30%. You had Rivian up about 32%. And of course, Tesla was up about 7.4%. But I think all of them are going to be sliding hard because of the pull forward sales that we just heard mentioned. There were a lot of people who wanted to get out there, buy those vehicles before the incentive went away on September 30th. And now I think we're going to see a real pullback for the rest of this quarter, the rest of this year. And I think maybe we're going to settle in the U.S. new car market share for EVs around 4% if we're lucky.
4%. So basically, if I remember correctly, the peak was about, 8% or so. So that share has basically is going to halve.
That's my prediction, at least. I think so. Don't forget that we've lost two components here. The carrot was the incentive to get people in to buy the vehicles, but the stick was the regulations and the fines that automakers were going to pay if they didn't produce the vehicles. Both of those have been removed. Technically, I think the regulations still say everything that they're supposed to be doing to meet all the EPA requirements and the CO2 requirements, but the administration has pulled all the fines. So if you don't meet all the requirements, you don't pay any money.
So look, if this is what's going to happen, what does it mean for the brands? GM, Ford, Rivian, et cetera? How are they going to handle it?
Well, I think the domestic automakers that are traditional car makers, Ford and GM and Stellantis, they're going to do what they know works, which is they're going to provide V8 engines. You know, Ram and Dodge have been talking about how the Hemi's coming back. Of course, we sell a lot of big trucks in this country and SUVs, Suburbans, and F-150s. They're going to produce those. That's where their real profit has always been. And they're going to produce as many or more of those as possible. They're not going to completely abandon EVs because they know, just as the political winds blew in the last 12 months and changed things, that'll happen again potentially at some point in the future. But in the medium to longer term, between now and 2028, they're going to maximize their profits on non-EVs and kind of just keep the low-level effort on the EVs going and maybe continue to develop them. We'd still love to see a breakthrough where battery costs drop dramatically and charging times go up. So maybe 4 years from now, 3 years from now, we'll have some major technological breakthroughs, and the electric vehicles will look that much more compelling to U.S. buyers.
Yeah, but for now, it sounds like pretty dire times. But for, the gas guzzlers, trucks, etc., your F-150 types, right? Because oil is on the back foot right now. I lost track of what the average price of gasoline is right now across the country, but that should be helping as well, yes?
Exactly. Oil prices have been relatively stable. People are pretty used to the current numbers. I mean, I'm in California, so the numbers are crazy because of all the fees and taxes they put on them. But most of the country has pretty, friendly fuel prices for driving V8s or larger, more powerful cars. And I think, we do want to see what's going to happen more so to these pure EV makers. To me, that's the real question. The domestics, the traditional automakers, they can steer right back into bigger engines and not worry about the regulations. But, the Rivians, the Lucids, Tesla, it could be brutal. It could be a brutal couple of years here.
Yeah, so if that's the case, I mean, we're not talking about them being in a doom loop just yet, but it's going to be, they've got some tough times ahead near term. And I find it ironic that this is without at all any competition from the Chinese. But I got to ask you an interesting question, and you've probably thought of this as well. If this is going to be the case for their names like Lucid, Rivian, and Tesla, very much on the back foot, even without Chinese competition, you remember the president's been talking about, and has been saying this since even before inauguration, that the idea of attracting or inviting a Chinese car maker to set up operations, manufacturing in the U.S. is not out of the question. That is a theoretical possibility for him, and will certainly, I think, do great things to try and narrow the differences between the U.S. and China. I mean, if that were to happen, names like Lucid and Rivian, and I'm not sure how Elon Musk is going to react to this, that would probably not be good news.
No, I mean, we know the Chinese have all these advantages on the price they're paying for their rare earth metals for their batteries. They've really secured those. They did that a long time ago. They had a lot of foresight there. And of course, government and the automotive industry work fairly closely with each other to make sure that their costs and their profits are strong. Bottom line is that they can produce really capable and advanced EVs at a price that nobody else can compete with right now. It's a fascinating concept, Martin, and all. And if a Chinese automaker could set up in the U.S., and be given essentially, almost no tariffs because they were set up here, it would add an interesting component to the competition and the pricing and the, what's going on in this country with all the domestics, both the pure EV makers and the traditional gas producers. But I think it would actually be good because, as you're saying, I think at some point we do have to stay in this game for EVs. We can make the money on internal combustion engines, and we should. Well, we can. I think that's great news for the domestic automakers, but they can't fall completely behind and just walk away from the EV development. They've got to be prepared in that area too.
So one way I think U.S. EV makers could fight back is, on the bat front. And on that note, I mean, this is something that is the equivalent of, I think, at least half the weight of the car, and maybe close to half the cost as well. So to get that cost down, if we could secure more supply chain in terms of the stuff that goes into bat, including critical minerals, that would probably be pretty useful. And it seems to be, with the Trump administration, and this is a very interesting whole of government approach is taking to this by, among other things, we were talking about, they're going to be buying into Australia's critical mineral reserves, 1. This is the UK, excuse me. The US is likely to follow suit as well. Once you get stuff like that going, you won't be as dependent on the Chinese for bat materials, especially processed bat materials. Something like this, can't come too soon for U.S. EV makers, yes?
100%, 100%. And that would be the smart thing to do, would be to use the next few years to go ahead and maximize profits where they can, automakers, while working with the government to secure alternative sources for these rare earth metals, continue to hopefully innovate on the technologies that will make EVs more competitive with gasoline and hybrid vehicles. And, they've got a breathing room here now, essentially. Let's hope they utilize it versus squander it and put things together so that, I don't think the EVs should be everywhere, but I don't think they should be nowhere. I think they should be competitive with gasoline cars without a lot of government help. And they can be eventually. How long it takes to get there, that's really going to be up to how hard they work here on everything that you just mentioned, the source of the rare earth metals and how inexpensive we can get those, and the innovations on the technology side to make the vehicles have longer ranges and faster charging times and better infrastructure.
Well, let's hope so. We'll see what happens because, in terms of alternative energies and the transition, wind and solar around the world right now are already cost competitive. The economics are there, but we'll see what happens with EVs. Carl, listen, always great to talk. Appreciate the time. You keep safe and do it again very soon. Carl Brower there from iccars.com joining us live. All right, still ahead on Squawk Asia this Friday. The practice rounds for the Formula One Grand Prix in Singapore kick off later tonight. CNBC's travel editor Monica Petrelli is going to join us next to tell us just how much money is generated in and out of the Little Red Dot from just a single night race once a year. When we come back in 2. Welcome back to TGI Friday here on Squawk Box Asia. So since the first race back in 2008, the Singapore Grand Prix has attracted more than 500,000 international visitors and generated more than $1.5 billion in tourism receipts. But the island, though, isn't the only place in Asia making money out of the race. CNBC's travel editor Monica Petrelli has been exploring the other options. Good morning.
Good morning, Marty. Yes, so it's no secret that money flows into this island during this week. Not only just to the race itself, but all the surrounding festivities, the dinners, the restaurants that are booked out, the business conferences. And this is especially true for those businesses and hotels near the track. Now, I have examined that in the past, and we've looked into that. But this year, a different question was on my mind. And I was wondering, well, how much does this money flow through Singapore's wider economy? So we started to look into this, and I found out that, yes, the money does travel across the island and actually goes much farther than that. Take a look. From $84,000 hotel suites to weekend packages that sell for six figures, Singapore's Grand Prix is a money-making machine for businesses near the track. But companies far from the 5-kilometer circuit are cashing in too. The ride-hailing company Grab gets an uptick in bookings during race week, while tailors get a boost from thousands of business travelers who attend conferences around the race. So even small businesses like coffee shops and this bakery here south of Chinatown say they see a bump in business from Singapore's F1 race, an event which has netted their country more than $1.5 billion in tourism receipts since 2008.
We do see the impact of F1 spilling out even beyond the racetrack, where tourists and even locals are exploring the surrounding neighborhood. So the increase in orders goes up to 20%.
They start to pick up maybe from Wednesday, Thursday. That's where the customers or the tourists are streaming in for F1 week. We just kind of like increase our staffing because we know that there will be an influx of customers.
However, data shows that tourism revenue from Singapore's F1 race not only trickles through layers of its own economy, but that of other destinations in Asia Pacific too.
We have different travel platforms who are bundling the F1 experience with other islands in Southeast Asia, including Bali and Phuket. So visitors will come to Singapore, will enjoy the F1, and then they move to Bali for 2 or 3 days. And that's actually amazing for the economy of the region.
The marketing platform Sojourn analyzed flight bookings for the 2025 Singapore Grand Prix, finding that among international attendees with onward bookings, 25% of Americans and Canadians are visiting Japan, 18% of Europeans are headed to Thailand, and nearly 1/3 of Australians are tacking on trips to Indonesia, namely Bali. Bookings show incoming travelers are also combining Singapore's race with trips to China, South Korea, India, Malaysia, the Maldives, and Fiji. So this matches a 2025 visa report, which shows other races in Asia Pacific generated tourism revenue outside of their host cities as well. According to Visa's data, foreigners who attended this year's Melbourne Grand Prix traveled throughout the Australian state of Victoria, to the Yarra Valley wine region, and even as far as Sydney. And 20% of foreigners who attended the 2025 Japanese Grand Prix in Suzuka also went to Okinawa, a city more than 700 miles away. Tourism revenue attributed to F1 races is largely measured in the week before and after a race. But there is more income that is harder to track, as it comes long after the car engines stop and the champagne bottles are popped.
You have millions or 100 millions of viewers over the television, social media. They are watching Singapore. They are seeing skylines, modernism, safety, and convenience.
Scenes which drive more interest to visit Singapore and other destinations in the region. Now, those that are most likely to plan onward trips after the F1 race are those coming from afar, and that makes sense. You got to deal with the jet lag after all, make it worthwhile to come all this way. But according to Sojourn's flight data, seeing a difference and a change in who is attending this year's F1 race, showing a drop in people coming from afar and a rise in those coming from within Asia. Now, we can see a jump in those coming from South Korea and China, with a drop from those coming from the UK as well as the US. Also, more Taiwanese. And just to put some numbers here, South Korean flights doubling, and those from the US headed in the opposite way, going about falling about 50%. Now, this could affect tourism revenue into Singapore because those that come from afar tend to stay longer. Those coming from Asia, they tend to come the day before or even the day of, that's today, that the race starts. Now, this is not the only change, though. We're also seeing a drop in solo travelers and an increase in families. And that shows that there's more interest in leisure travelers coming for F1. And that really comports with what we're seeing with rising interest in F1. And also, leisure travelers saying that they will travel to attend sporting events and also music.
Yeah, all the events around the race weekend. All right, interesting. So I know ahead of the race on Sunday, Mon, you had a chance to talk to the folks over at McLaren, right? They're team-wise, they're leading the season so far, as well as the crypto platform OKX.
Yes, I did. I sat down with Zach Brown and also Haider Rafiq, and it was a great conversation, and it was an interesting one because those two don't often sit down to have an interview together. So it was a nice opportunity to speak with both, and we talked about the partnership and how they each benefit from a partnership like that. Also, OKX coming on board with McLaren when it was not the McLaren of today. It was not winning races when OKX came on board. So I asked, does that factor in when they go back to the renegotiating table? They were a bit mum on that, but didn't deny that. But we also talked about the rising interest in F1. And I asked Zach Brown, well, how do you make sure that people that are now interested in F1 become McLaren fans, right? Just because we're seeing more people, younger people, women, bigger interest in markets, how do you make sure that they become, they join Team McLaren? And here's what he said.
We've got quite an iconic brand. We're the second most successful team in the history of Formula One, so we're at a good starting point. Then we're very fortunate to have what we think is the best driver lineup in the sport, not just on the track, but off the track. And Orlando and Oscar are fantastic drivers on the track, but great personalities, youthful, kind of really resonate with the younger and the trend fans of our sport, which is what our future is. And then our sponsors like OKX, who talk to hundreds of millions of fans, and they've done an unbelievable job of recognizing our history, but bringing that history into the future.
So OKX also needing new fans or users per se. How does a partnership with McLaren or also with Manchester City, how does that work? And how do you measure whether it's worth it to your company?
Well, look, the interesting thing about our category the last few years is crypto now is becoming widely accepted. It's becoming accepted by banks, large institutions. Regulators are putting the right frameworks for crypto companies to go onshore and exist. So partnerships like this help us get the ultimate distribution. When McLaren has a lot of conversation online, we see the conversions of more and more people downloading our apps. Say, we're in Singapore today. Over the weekend, we expect there's going to be a significant uptick in the number of people that download our app. So the business results become apparently clear.
Now, we also spoke about growing talk of expanding F1 races as we see more cities and more countries sort of putting their hands up saying they too would like to host a race. Everyone from Bangkok to places like South Korea that used to have an F1 race and shuttered it from lack of race attendance and also financial losses. Now, Zach Brown saying he's not a fan of adding more races on. They're already 24 on the roster. But if you can look through the history, you can see more races through the years have been added. He's more of a proponent of rotating cities, such that a city might host every other year. Now, Marty, I did talk to him about if that happens, say, for example, Bangkok, does that then take away some of the specialness of the Singapore night race, at least in terms of tourism revenue? And also, does you run the risk of like F1 fatigue if just more and more cities are hosting races? And he said, with the interest growing as it is now, he's not concerned about that.
Yeah, talking about fatigue, I think the race Sunday has been declared, hazard conditions for the first time, right, by the stewards, because I think the inside the cockpit for a lot of these F1 racers, it's going to be north of 41 degrees. I mean, this is Celsius, of course, so it's going to be tough for them. But talking about that, you mentioned that Zach was telling you that the audience, right, for F1 has really been exploding globally. And the new cohort of the demographic, which is really pricking up a lot of eyebrows, women are catching on and enjoying F1 and liking F1. I'm really curious why that is, and I'm thinking maybe it could be when you think of some of the new young stars, Lando Norris, etc., Oscar Piastri, when you look at them, I'm thinking, they travel the world, right? This is like the modern day equivalent of boy bands going around the world. What do you think?
Yes, I do think that that's part of it. Now, I did ask, what is behind this growing interest? Yes, the power of TV. We know the Netflix series Drive to Survive. Now Brad Pitt starring in F1 the movie. What else? And it really does seem that there is a lot just to these shows, because even studies have shown the more gear you have on you, the less an audience can really relate to you. That's something that, say, boxers don't face, or baseball players. You can see their faces typically. Basketball. Race car drivers, helmets, ensconced in cars. Yeah. You don't really see them. That's changing. TV is changing that, bringing these people to life. Also, social media. A lot of these people, and you're right, the drivers, they're young. They have a growing social media presence, so people can get to know them. And then you can make that connection. Now we're seeing more fans on both sides, male and female.
Yeah, fangirls and fanboys. All right, great stuff. Mon, enjoyed your coverage, and looking forward to the race this weekend coming up on Sunday. CNBC's travel editor Monica Petrelli there, ahead of the Singapore Grand Prix, again, which happens on Sunday. All right, for more on F1 success in Singapore, all you have to do is get onto our digital arm, CNBC.com. Double-click there to read Monica's full digital piece. Go there now. And a last look at markets before we go out. This is how we're shaping up. Lee from Wall Street, we have the NASDAQ and the S&P cracking up to yet more record highs. And the translation, yep, we are seeing positive fall throughout here. The bottom row there, not so much. Singapore is down a third, Hang Seng down more than half. But take a look at the top row. Tokyo especially, it's up at 45,623 and 1.5% ahead of that LDP presidential election, which happens this weekend. So I don't know what that says. It's going to do it for this Friday edition of Squawk Asia. Thank you so much for watching. Keep it right here on CNBC. The China Connection is coming up next. Safe weekend. Good weekend. We'll see you Monday.